Donald Trump is doubling down on his brand, that blue wall, which is, quite frankly, President Biden's best chance at retaining the White House.
I think this is a market that's pulling forward a Trump win.
A lot of the Trump effect is starting to be priced into markets already.
The tariff story is probably going to be the big one that we have to wrestle with.
Those tariffs do raise a lot of inflation uncertainty. And again, it will complicate the Fed's story, the Fed's message.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance begins right now. We're coming into Wednesday at all-time highs on the S&P 500 with the attention firmly on the small caps. Stat of the morning comes from Rita Nazareth over at Bloomberg News with this one. Over the past 4 sessions, the Russell 2000 has beaten the Nasdaq 100 by almost 11 percentage points. We haven't seen moves like this, Danny Berger, since 2011.
Okay, I have a better one for you. Over the past 5 days, it's outperformed the S&P by the most on record. It's really been kind of a healthy rotation because you hear that and you're like, okay, the Nasdaq, S&P surely getting pummeled. They're treading water here. There's a sense that the strong hands haven't folded. I wonder if the politics changes that. 5
days of gains on a Russell 2000, a move of more than 11.5%. Absolutely phenomenal. We need to talk about the politics. I need to start with foreign exchange, though, before we talk about the politics. Can we bring up dollar yen? Dollar yen with a big move lower. So this is yen strength. There is one single quote that jumps off the page in the Donald Trump interview with Bloomberg Business Week. Here's the quote. Danny, we have a big currency problem.
It's a Trump that is not pro-dollar, but Trump policies that are indeed pro-dollar. It's a confusing thing to get your head around. But for the end, I had a conversation with Mark McCormick of TD this morning, basically saying Japan's going to try to get out in front of this. Part of the reason they're going to hike, not just the economy, is because they don't want a weak currency level for fears of tariffs. So I don't know, maybe we see this kind of, maybe that's what ultimately weakens the dollar, or other countries. Again, it's all very confusing.
You mentioned tariffs, so let's get into that.
Sure.
This is where it's really confusing for me. If you ask someone on the street, someone in foreign exchange around this table, what will tariffs do to the US dollar? If President Donald Trump comes in, gets a second term, cranks up tariffs on China, what happens to the dollar? Most people around this table say the dollar gets stronger. So he wants to do one, and at the same time, too, says this. I've been talking to manufacturers. They say nobody wants to buy our product because it's too expensive. That's a direct quote from the former President Donald Trump. So how do you go about this? The dollar's too strong, but we're going to put up tariffs, and that's going to mean a stronger dollar. How are they going to offset that?
Well, one of the ways you could offset it would to have a Fed chair who doesn't want to hike or continues to cut as much as we are right now in the face of higher inflation. But it's also Donald Trump who, in speaking to Bloomberg, said that, yes, he would allow Powell to carry out his term. Of course, I mean, he doesn't really have the political power to not allow him to carry out his term. But you got to wonder, how do you get a weaker dollar unless you have a Federal Reserve who is willing to let inflation run?
Some of the takeaways here would not fire Chairman Powell, would allow him to complete the term, but doesn't want them cutting before November. I wonder how the mood might change around this Federal Reserve if they did cut before November.
Right. Well, I mean, Donald Trump, again, one of the big takeaways from this piece with Business Week is that he views relationships very personally. So that is a concern with Powell. Just go back to the idea of him talking to manufacturers saying that it's too expensive. There are other reasons besides a strong dollar. We don't have the supply chains to allow for cheap equipment. By the way, Europe doesn't want to buy our giant gas-guzzling cars. It's more than just a dollar here.
There's a lot to talk about this morning. We're down about 7/10 on the S&P 500. There's a chip story in the mix that we'll build on a little bit later. That's the equity story. Let's get to the scores elsewhere and start in the bond market and look at treasuries. Yields all over the place this week. Higher then lower. Up again by a single basis point. 416.92 is where we are on the US 10-year. Foreign exchange, there's that weaker dollar across the board in G10. That's that stronger euro, 109.43. We're firmer by 0.4%. Coming up this hour, we'll catch up with Brian Nick of NewEdge with small caps up 11% in about 5 sessions. Sarah Wolfe of Morgan Stanley on signs of retail resilience. And Herman Chan of Bloomberg Intelligence on the rally in regional bank stocks. We begin with our top story, the big rotation. Small caps on a major 5-day winning streak. Brian Nick of NewEdge writing this. We closed our underweight to US small caps versus large in light of the softer inflation data. Likelihood of a further unwind in negative positioning and more optimism that will comfortably avoid recession. Brian, good morning. Congratulations on the new seat. Always happy to see that. You're not the only one that closed their underweight on small caps last week, quite clearly.
We're not in the business of standing in front of moving trains.
Why can this continue?
Well, we're not sure it is going to continue for very long. We see this as sort of a multi-month position change. We could see ourselves easily moving back to underweight if we either see growth weaken or if it seems like we're not going to get the rate cuts that the market is priced in. The market is well ahead of the Fed. This is clearly what's propelled a lot of the small cap optimism. We need to see some of the earnings fill in behind this optimism, behind the re-rating in small caps. We need to see home builders turn around. We need to see more construction, more hiring generally in the economy. So we see the cyclical upturn in the second half of the year, which is the only way we're going to hit small cap earnings targets for 2025.
When you start to think about earnings, are you more convinced by the earnings that may come from big cap tech? And would you be unwilling to sell some of those major players to fund this long that we're seeing develop in small caps?
So effectively, we have done that because we had this overweight to large cap. So we have been selling some of those very high earning, high growth companies. But again, we're not buying into sort of a junky rally here for small cap. We're still emphasizing quality across the portfolio, which means that even being neutral, we could see ourselves underperforming the small cap index in this kind of environment where things are sort of indiscriminately moving upward. What we're really concerned about, though, is the fundamental story in 2025 and the very, very ambitious earnings targets that if they're not met, it's not really going to matter how many times the Fed's cutting rates.
Well, to this point, large caps, the big tech, yeah, they've fallen, but not by a large degree. There was this narrative out there that once the rotation happens, it's going to be violent, it's going to hurt, everybody's overpositioned, yet we have an S&P that's up 1.5% over the past 5 days. That's not exactly violent. What do you make of that?
No, and we could see more days like this one where it was become so familiar in 2024. We had days where 80% of the index was down, but somehow the index itself was up. We could see more days like this one where we have a little bit of a more kind of violent unwind rotation, especially with the headlines around chips hurting tech. But again, we don't think the economy is slowing that much or that quickly that we should be seeing across the board cutting in risk in portfolios. Yeah, we want to trim a little bit, and some of the names have gotten too expensive. That was part of the rationale here, is a valuation play, like wanting to go into underperformers, underowned, oversold, and also cheaper. But you need the economy to perform well. And when we see the economy slowing down, it's going to be those bigger growth names with better secular growth stories they're going to continue to lead. And that could be very well where we're back in that situation by the fourth quarter.
Right. Well, for now, we're trading sort of this Goldilocks thing where it's slowing down, but still allowing the Fed to cut. Just in the moves yesterday, because we've been concentrating on small caps, it wasn't just that. Home builders up 6%, regional banks up 4.5%, unprofitable tech up over 3%. Is there some degree of irrationality in the moves?
I don't think in the home builders there is, because they're so rate sensitive. And we've been saying this whole time that, okay, well, the Fed's been raising interest rates, but it doesn't seem like it's hurt the consumer. There's not that much evidence that cutting interest rates is going to help the consumer. But we know the parts of the economy and the markets that were ultra responsive to rate hikes in 2022 and 23 were the housing related parts. So we've been pessimistic, right? If rates are going to stay higher for longer, that's not going to be good for home builders. But as soon as there's this indication that inflation is going to be lower and the Fed's going to acquiesce and start cutting rates sooner and maybe by more cumulatively over the next 18 months, that's going to be very good for home builders. We didn't see it in the confidence number yesterday, which I was a little surprised about. Maybe it's going to take another month for that NAHB, which is a really good leading indicator, to start moving up again. And maybe we'll see that in the data this morning, too, with permits and starts.
Brian, you talked about rates. Let's talk about the bond market. So this time, Monday morning, we had a bear steepener. And then this time, yesterday morning, we had a bull flattener. And we're trying to work out what's more important here. The economics, the macro backdrop, the Federal Reserve, or the politics? What's more important here?
I think everything is pushing short-term interest rates down. If you look at the politics, clearly if you had a Trump win, he would prefer shorter-term interest rates. I think there's some people in the FOMC right now who are advocating for not cutting rates, who might be in the discussion for the big job, who might decide they want to cut rates after the election. We'll see. But I think the steepener trade clearly is when people ask, what's the political trade right now? It's clearly a steepener, whether it's bull or bear, because the fiscal situation, if you're going to cut taxes for corporations even further, if you're going to make those individual tax cuts permanent, that's going to tend to raise the longer end of the curve, all else equal. At the same time, if you have some power over the Fed to try to get them to cut rates, where they just are inclined to do that because inflation's down, you're going to get that steeper. So that's kind of how we'd play. And we actually are advocating people moving out of ultra short duration cash and extending duration in portfolios for that reason. I think the longer end of the curve is going to stay higher for longer.
There's a foreign exchange question in the mix as well. We shared that quote from our interview with Donald Trump at Bloomberg Business Week. We shared that quote at the top of the hour. We've got a currency problem. Now, if the President of the United States comes into power and is talking about having a currency problem, are words enough? Do they need to back that up with policy? And what does that policy look like?
The words might have to be enough, because it's not clear what would you do to weaken the dollar at this point, other than just deliberately trying to weaken the economy or creating a sort of a sense of non-credibility when it comes to the central bank. It's possible that at this point we're sort of past the past the point on the curve where doing more fiscal stimulus could actually weaken the dollar if it looks like the debt situation is becoming worse. But we haven't seen that in other places where they have much larger debt GDP ratios necessarily. So I think it's a tough thing to accomplish if you're trying to erect tariffs or enact some kind of trade restrictions, but also keep your currency weak. And at the same time, the economy in the U.S. is still much stronger and much more well-diversified and resilient than the other countries that we're talking about here to try to weaken the dollar again. So it's a hard policy to accomplish from this starting point.
Yeah, but you could look at today and say, well, he's done it with the yen. The yen is considerably stronger versus the dollar today. Presumably, this just translates into more volatility, more fits of starts. If there is some element of jawboning that maybe doesn't last. So how much conviction can you actually have in something like a strong dollar trade for 2025?
If we're doing big fiscal expansion, which is probably like the sort of the low-hanging fruit for what the new Congress and the new president could do in a scenario where Trump wins, I don't think you do see the dollar weaken. I think it would still continue to play the pro-dollar because you're going to have relatively high interest rates. It might stop the Fed from cutting as much as what's currently priced in, or even what the Fed would say they're going to do at this point. And I think that keeps the dollar strong against the euro, the yen, British pound, and basically everything. And that doesn't mean it's incompatible with a rising equity market. I think you'd see some of the companies that are benefiting from this last kind of pocket of moves that we've had continue to do well in that scenario, where we have sort of an overheating, overstimulated economy. But I don't see the dollar weakening in that scenario.
Brian, it's good to get your opinion, and congratulations again on the new seat. Brian Nick there. Now with NewEdge. Your equity market on the S&P 500 negative here by 0.75%. There is a big reason for this. It's in the chip sector. We'll talk about that right now. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. A changing of the guard at HSBC, the bank has named Georges Elhedery as its next CEO. The decision continues the lender's tradition of picking insiders to run the bank. Elhedery will take over as CEO in September. He replaces Noel Quinn, who in April announced his surprise decision to retire from HSBC after a more than 3-decade career. The Biden administration is considering ramping up its chip crackdown on China. Bloomberg learning that the U.S. has floated using the most severe trade restrictions available if companies such as ASML continue giving China access to advanced semiconductor technology. The potential risk hitting shares of ASML even as it posted second quarter earnings and sales that beat forecasts. And prior to the assassination attempt and shortly before his debate with President Joe Biden, Donald Trump spoke to Bloomberg Business Week about his economic plans for a second term in office. In the 90-minute interview, he said he does not want to remove Fed Chair Jay Powell from his position. He wants to bring the corporate tax rate to as low as 15%, and that he'd even consider Jamie Dimon to head the Treasury. The full Bloomberg Business Week interview is available now on the terminal or for subscribers on Bloomberg.com. That's your Bloomberg Brief. John?
Yahara, thank you. Much more from Yahara and that interview a little bit later this morning. Up next on the program, from fierce critic to staunch ally.
Chaos follows him. And we can't be a country in disarray and a world on fire and go through 4 more years of chaos.
For the sake of our nation, we have to go with Donald Trump.
What a difference a few months makes. That conversation is up next. Anne-Marie in Milwaukee, Wisconsin, on the other side. From New York City this morning. Good morning. Sneak peek of the price action for you, down about 0.7% on the S&P 500. Chip players, Danny, struggling this morning. Difficult, really, though, to know how much of this is about maybe President Biden making it more difficult to chow some of these chips over to China, and how much of this is just a continuation of some of the move we've seen over the last few days.
Well, to be fair, the move over the last few days has been mostly NASDAQ and S&P steady. So this might just be kind of the extra push to get a sell-off in some of the larger big cap names.
Down 0.7 on the S&P, yields up a little bit as well by a single basis point. The 10-year 4.17. Under surveillance this morning, from fierce critic to staunch ally.
Chaos follows him. And we can't be a country in disarray and a world on fire and go through 4 more years of chaos. We won't survive.
For the sake of our nation, we have to go with Donald Trump. Donald Trump has my strong endorsement, period.
It's the latest. Republican speakers uniting behind presidential candidate Donald Trump at the RNC in Milwaukee. Attention now turning to a speech from Trump's vice president pick, J.D. Vance. I want to go to that quote and bring in Anne-Marie. AMH, you're at the RNC. 4 more years of chaos, we won't survive. Not the words of a Democrat, the words of Nikki Haley just a few months ago.
Absolutely, Jonathan. This, what many are calling, is about unity, but I think some critics would also say, this is sheer politics. This is Donald J. Trump's party now, and you saw that firmly this week as well with who he decided to pick as his VP candidate, who we're going to formally see accept that today in a speech today. But you're seeing the foes come on board to the Trump camp. She called him unhinged. She said chaos follows him everywhere. This was the quote last night. My message is simple. You don't need to agree with Trump 100% of the time to vote for him. And she wanted to make it clear as she came out on that stage, Jonathan, to a lot of boos as well. She wanted to make it clear. She says Donald Trump has her full endorsement, period.
How united is this party? Boos for Nikki Haley. Mitch McConnell gets booed when he walks into the convention at the start of this week. We've all seen the footage of Matt Gaetz arguing with Kevin McCarthy. We know how personal that is. How united is this party now?
They're trying to say that they're united, especially given the events over the weekend with the attempted assassination of former President Donald Trump. He's talking about the fact that he's ripped up his script and he wants a call for unity and he thinks he can be willing to do that. But under the surface, of course, is a very divided party, not just divided on the politics and some of the personal politics and that video circulating around the internet of former Speaker Kevin McCarthy talking to a reporter and then Matt Gaetz coming and bashing him, that individual who led to his ouster being Speaker of the House. There's a lot of personal politics under the surface and a lot of policy divergence. And you see that as well in this interview that former President Donald Trump gave to Business Week on a number of issues, whether it's the economy, whether it's foreign policy. It's really two GOPs in one. But right now, they are firmly focused on trying to win and take back the White House in November.
Well, to that, Nikki Haley, in her speech alone, even though it was an endorsement for Trump, she said that she wanted a president that will fight enemies but stand with our allies. From that interview with Trump in Business Week, you didn't exactly get that flavor from him.
No, and I would point to one of the most important quotes on foreign policy that everyone in the national security world is going to be discussing, and this has to come with Taiwan. Donald Trump was basically questioning why the United States should protect Taiwan. This is what he said. He said, I think Taiwan should pay for a defense. We're no different than an insurance company. Taiwan doesn't give us anything. Taiwan is 9,500 miles away. It's 68 miles away from China, a slight advantage. And China's a massive piece of land. And he also talked about that in Taiwan, that's where all the chips are. And they took business away, he says, from the United States. I wonder if this is a similar Trump playbook that he used at his first term in office when he talked about how, when it came to NATO, that Europe and these European countries, notably attacking Germany, that they need to pay 2% if he's going to try to use this as a negotiation to get something out of Taiwan. But he certainly was questioning the U.S. defense for that, or potentially who should be paying for that defense.
Marie, you've spent a lot of time with leaders abroad, most recently at the G7 in Italy. There's been a lot of talk about Europe preparing for a Trump 2.0, but we didn't know exactly what that would look like. Is this a Europe that is prepared for that? Again, just given some of the language we heard from him in his interview with Business Week.
I would say two things. One, it was certainly clear at the G7, definitely at the NATO meeting, most recently in Washington, D.C., that European leaders, U.S. allies, are preparing for Trump 2.0. One thing is clear. They understand the playbook. They understand the individuals around him. So potentially they can start making those inroads now and trying to have influence. We saw this with former UK Foreign Secretary David Cameron going to Mar-a-Lago. Viktor Orban, who seems to be a close ally of former President Donald Trump, just went to Mar-a-Lago as well. They are seeking out these meetings. One thing from the Business Week interview is very clear, and a lot of notes that are coming in this morning. I looked at what Goldman Sachs is saying about a potential Trump 2.0 and what that would mean for tariffs on Europe. He looks that he's going to want to put up this 10% tariff roll around the United States, we're all talking about what this would mean, of course, for China and the imports China has on the U.S., but still a 10% tariff roll around the United States would mean almost potentially no growth in Europe.
Just a fantastic interview in Bloomberg Business Week. If you are just joining us, a sit-down with Donald Trump. A sit-down from about a month or so ago. President Donald Trump also telling Bloomberg Business Week that we have a big currency problem. That's a theme we'll revisit throughout this morning. Anne-Marie, I want to talk about some comments from the sitting president, Joe Biden. In an interview with NBC, he's made this point several times, that he wishes the media would be more focused on Donald Trump. I have to be direct about this. Anne-Marie, he's lucky that the media is. Because if they weren't and they were more focused on him still, like they have been over the last 2 weeks, we'd be sitting here this morning talking about an address yesterday that wasn't great, not great at all. And I imagine if we didn't have the tragic event of Saturday evening, we'd be talking about more House Democrats coming out this morning asking him to step aside.
It's a great point, Jonathan. If we didn't have the RNC this week, every single movement that we have seen current President Joe Biden make would be under that magnifying glass and it would be scrutinized, including his speeches yesterday and also that Lester Holt interview that definitely got a lot of pickup and individuals were talking about, but not as much given the attempted assassination on former President Donald Trump and the fact that the RNC is taking place this week. It's almost taken up all the oxygen, wall to wall on network news. And I think that's given some breathing room, as we heard from Henrietta Trey's yesterday, for President Joe Biden, because his performance has been lackluster. And that interview with Lester Holt, if you're a Democrat and you're sitting in Congress, it didn't really do enough to assuage concerns that this individual is going to be able to not just win, but govern the next 4 years.
We sat here Monday morning and we talked about how one-dimensional the Biden campaign has been, almost exclusively around one idea, to borrow a phrase. And that idea ultimately is the existential risk that Donald Trump poses to democracy. We've heard that on repeat. And we questioned whether they could continue sending that message after the events of the weekend. I have to say, Anne-Marie, after the last 24 hours, it feels like even after just a few days after the assassination attempt on the former president, we're back to where we were. It's campaign as normal.
It is campaign as normal. And Joe Biden did say this to Lester Holt. He said he does want to tone down the rhetoric, but he did try to explain why he thinks Trump is an existential threat to democracy. But he tried to pivot and talk about some of what Trump's policies are. What we keep hearing from this campaign, though, is that they haven't been able to expand upon that one-dimensional. They want to make it about a referendum on former President Donald Trump's prior 4 years, even though Joe Biden currently is the incumbent in the White House.
AMH, great to catch up. I know we'll catch up with you again in about 60 minutes' time. Anne-Marie sitting down with Virginia Governor Glenn Youngkin at the RNC in Milwaukee, Wisconsin. Do not miss that conversation. I know lots of you just tuning in, so welcome to the program. The takeaway from our sit-down conversation with Donald Trump for Bloomberg Business Week, he would keep Chairman Powell in the position. He doesn't want them cutting before November. That's not going to come as a surprise. He would consider Jamie Dimon, the chief executive and chairman of JPMorgan, as Treasury Secretary. And Danny, we've gone over this repeatedly. He's got some strong ideas, some strong thoughts on the strength of the US dollar.
I've seen a lot of commentary coming out after this interview saying, you know, it's pretty benign. He doesn't want to replace Powell. He's talking about Jamie Dimon. That seems sort of a status quo, establishment person coming in. But when you factor in some of his policies on tariffs, you got to question whether he'll really live up to that, because he wants tariffs, which means more tax cuts for the public. And then you get sort of a higher inflationary environment, which means that you have a Fed that can't cut as much or needs to hike, which means a stronger dollar. Again, the rub in that is the Fed. The Fed is kind of standing in his way. So he can say all he wants. I'm going to keep Chair Powell on until the end of its term. But if the Fed is standing in his way for a weaker dollar, will he really hold to that promise?
What is Trumponomics? He said it himself. It's low taxes, okay, and it's low rates. I'm not sure how you get one and the other. And that's going to be really difficult for them next year. Adam Poston sat here, Peterson Institute. He brought this up first on this program. If the former president goes through with these tariff plans, you're talking about an inflationary burst in this country. Short term maybe, but one the Fed might have to respond to. And then we'll be talking about rate hikes in 2025. And then we'll revisit that question on Chairman Powell, I imagine. Coming up on this program is Sarah Wolfe of Morgan Stanley on the upside surprise on US retail sales. That's next from New York. This is Bloomberg. Live from New York City, welcome to the program. Here's the price action for you on the S&P 500 three-day winning streak into Wednesday. We take some of it back. We're down 0.7%. The Nasdaq down by more than that, off by 1.2. Outperformance again. Guess from where? It's the Russell. Unchanged on the session. Anything but unchanged over the last 5 sessions. We're talking about double-digit gains on the Russell 2000s in just 5 days. We'll come back to that, switch at the board and get to the bond market. It's been confusing, hasn't it? Monday morning yields up a lot. Tuesday morning yields down a lot. Wednesday up a basis point. Danny, 417.30. What's the more important force to this bond market right now?
Okay, I gotta say it's politics because we've already fully priced in 3 Fed cuts. It's not that the economy and the Fed isn't important, but how much juice is there really to any sort of bond market rally when, again, we're 2 more than what the Fed has priced in their dot plot. I mean, we've gone ahead of them. So what's left to be priced in? You have to argue it's politics.
Switch at the board and get to foreign exchange. I think we can argue once again it might be politics. Take a look at this right now. Dollar yen with a big move. The dollar weaker against everything in G10 at the moment. Dollar yen 156.43, down by 1.2%. Look, this has been a funky currency pair for the last month or so this could be moving on absolutely anything. But the comments from Donald Trump in Bloomberg Business Week, we've got a currency problem, I think will reverberate around foreign exchange up until November.
I just can't get over the irony of Japanese officials of the MOF trying their hardest to jawbone, trying their hardest to intervene. And what finally strengthens the yen? It is Donald Trump talking about it. So weirdly, this works out pretty well for them.
They both want the same thing, apparently. Dollar yen 156.44. I just want to have a quick look at what's happening with sterling. Sterling is a little bit stronger as well, but I don't think this is about the politics. This is about the data. We're back through 130 at 130.38. We thought we'd open the door to a cut in August at the Bank of England. How much of a nightmare is that data this morning for the officials on Threadneedle Street?
I mean, you gotta hope they look through it. Because if you look at the data itself, services were really hot. You dig even further in, it was hotel prices. And I hate to say this because it's almost become a cliche at this point.
Say it.
You had Taylor Swift there.
It's true.
You had Taylor Swift. You had everyone traveling. I mean, Mohammed Al-Arian goes to Europe for it. How many American friends do we have that traveled over to London to go see Taylor Swift? It had an impact. And I don't know, that's not a sustainable impact.
We're blaming Mohammed going to Paris. Is that what we're doing? Mohammed can answer that himself,
yeah,
maybe.
Well, again, this is UK inflation. Once we get more of the French numbers, then we can blame Mohammed.
We'll blame that on Mohammed a little bit later this week. Under surveillance this morning, we won't do that. Top stories for you. This one right here. What a wow story in the last 24 hours. The Secret Service boosting security around Donald Trump after picking up intelligence in recent weeks of an Iranian plot to assassinate the former president. Iran has denied the report, and there's no indication of any link between the intel and the Sunday shooting at a rally in Pennsylvania. I should say the Saturday shooting. Danny, just an unbelievable report. I think yesterday from CNN, was it?
Yes. And it just underscores what a colossal failure the Secret Service had. If they had this information before the rally and still allowed an open air rally, the only thing I can think of, John, is that they must have assumed that this threat wasn't fully realized. And there's some reporting on that that's what they believe, because this would be a serious escalation for Iran to go after a presidential candidate already when there's a hot war in the Middle East that involves some Iranian proxies. I gotta imagine that's why maybe you didn't have Trump moved indoors or something like that. But again, it just points to this fact. If they knew this, why did they allow him to have a rally in an open field?
Just absolutely shocking. I think we've all got big questions about that and still no answers. I want to turn to this because part of the move this morning that we're seeing on the equity benchmark, the S&P and both the NASDAQ 100 as well, lower, is because of this story right here. The US chip war with China showing no signs of easing. We're reporting here at Bloomberg that the Biden administration is considering the most severe trade restrictions available if the likes of Tokyo Electron and ASML continue giving China access to advanced semiconductor technology. Where does this leave some of the American allies right now producing some of these goods? There's 4 months left, potentially, until November when we find out that maybe it's not President Biden anymore. It might be President Trump.
And it's not only that, it's also a new Dutch government, too. They have a very right-wing government, their most in history, and we don't really know what their relation with China and what the chip industry is going to be. But I was kind of thinking about this. I was thinking if you wanted to build a contrarian portfolio where you say, I think Biden's going to be elected, because right now we've been trading Trump. If you wanted a contrarian portfolio, you're getting the flavor that it might be short big tech.
Tech's getting short Either way, right? Okay. Big tech's down today. The Nasdaq is off by about 1 full percentage point. The S&P 500 down 0.7%. Let's turn to this story. New York Fed President John Williams telling the Wall Street Journal the central bank is getting closer to cutting rates, but won't be ready to pull the trigger at this month's meeting. More Fed speak coming later from Barkin and Waller. Sarah Wolfe of Morgan Stanley expecting 3 rate cuts this year starting in September, writing this: the deceleration in consumer spending is largely concentrated in goods, while services consumption is slowing but remains the top priority among households. Sarah joins us now for more. Sarah, great to be with you. Let's build on the number we got yesterday. Retail sales coming in better than expected. There was a shaky period when we started to worry about maybe the consumer losing the tailwinds of the last, several years or so. Then retail sales happened, jobless claims happened. I think there's a little bit more confidence. Do you think we can park that concern, Sarah, around the consumer?
I do think there is a genuine slowing that we're seeing in consumer spending, but now we could say that the first quarter, where real PCE stepped down to 1.5%, which is about half the pace it was running last year, was likely overstated by higher prices and some seasonal factor distortions. The second quarter, we're getting a much cleaner read on consumer spending, which is chugging along around 2%. That's still a slowdown from last year, and it's in particular coming in a pullback in goods consumption. But I don't think we need to worry that consumer spending is falling off a cliff. I'd be a little bit more worried if the 1.5% that we got last quarter had to be extrapolated forward throughout this year.
So should the Fed be cutting if we've got interest rates at about 5.5 and we've got CPI running close to 3 and GDP tracking at 2? Is that a decent world to be in?
I think the top priority right now is inflation. Inflation's coming down better than the FOMC expected. We have it coming in at 2.6% by the end of this year. Their projections show 2.8%. And so we do think that inflation is what's going to get the Fed to start cutting. But this slowdown in economic activity, this slowdown in the labor market, we think is what keeps the Fed cutting, and we get 3 cuts this year, as you mentioned previously. One of the things to note is that even though GDP is running at 2%, we've done a lot of work on the fact that stronger immigration is driving higher population growth. So near-term potential GDP is likely above 2%. And so we are seeing depressed economic activity. It's just hard to pin it relative to pre-COVID when we had a smaller economy.
So you're getting into one of the complicated things of 2025. What happens if there's a serious clampdown on immigration?
It's a huge risk to our 2020-25 outlook. Right now, we're dealing with a positive supply shock, which is helping increase labor supply, bring down inflation, help ease some of the wage pressures. If we were to see a negative supply shock, either we clamp down the border or there's deportations, that would be a negative shock to labor. We do see that as negative for growth and likely later positive for inflation. And so in that outcome, we actually see that the Fed might have to be easier on policy in order to react to the negative growth effect, which will be the first order effect that we see.
So there's been this interesting thing happening in the labor market underneath the surface, and that's the kind of jobs that are happening. We've talked a lot about some of the job losses and whether that will move in a nonlinear way, but the balance of jobs has shifted to high production type growth, high productivity, high pay, things like the sciences industry, where the losses have really come from the lower productivity workforce, things like hospitality. What sort of shift is that? Is that structural, and what does it mean for American growth and productivity to come?
The reality is that we saw the most strength in these lower income sectors like leisure and hospitality, healthcare, et cetera, over the last few years because we were backfilling. But now that the backfilling is done, we're seeing a shift into these other industries that are a bit more high productivity, as you mentioned. I think that there's going to be a huge question on how AI influences the productivity of these industries. What we have highlighted is that it's very likely that AI is going to slowly find its way into a broad set of industries and help augment the workforce and bring productivity back to these lower productivity sectors, like the hospitality industry, for example. But, we're very optimistic. We think that there is going to be more of a productivity boom. It's slowly going to roll out in the economy, and it's going to help augment the workforce instead of, the rollout of AI replace workers. We don't think that that's going to be the base case.
Sarah, these are big long-term themes. Can we talk about the end of this month? Forgive me for having a really short time horizon. Do you think the July Fed meeting could be a live meeting? Do you think there might be some officials pushing for that cut as early as July?
I do think the bar is very high for July to be a live meeting. We don't get much more data between now and the July meeting. No more payroll prints, no more CPI inflation. And so there's no new real data that's coming in besides jobless claims, which we saw, retraced a little bit. So if we did see perhaps a really large acceleration in the next couple of weeks, it could make it live. I think much more likely is that we're going to see some notable changes in the July FOMC statement that push the Fed more clearly to set up for a September cut. And what do I mean by that? Right now, the statement is very attentive to inflation risks. The last week when we heard from Chair Powell, he said inflation is not the only risk that they're watching. Maximum employment is equal to price stability. We expect that the FOMC statement is going to have a lot more on that maximum employment side of the mandate because of the softening that we're seeing in the labor market. And that's going to tell markets that it's not just inflation that's driving cuts now. It's the broader economy that the Fed is watching. And at this point, Chair Powell doesn't want to cause undue weakening in the labor market and the economy.
Sarah Wolfe of Morgan Stanley, going into July and beyond, looking for that first rate cut in September. Remember, we have Jackson Hole in between in late August, so that's one to watch. Sarah Wolfe, thank you. Let's turn to London now. The first King's Speech under the UK's new Labour government is underway at the Palace of Westminster. Joining us now is Bloomberg's Tom Mackenzie. Tom, it's an interesting one, isn't it? We've seen a few of these over the years. It's his words, ultimately spoken, but ultimately someone else wrote it, didn't they?
They did indeed. And the person behind that speech, of course, is the new Prime Minister Keir Starmer and his team, of course, the Cabinet. And this is the opening of this new Parliament with a Labour government with that significant majority. So what we're expecting, John, is a flurry of bills. There will be those critics who say this is a government that's not being as courageous as it could be. But in terms of the number of bills that are going to be presented in this speech over the next 15 to 20 minutes, you're going to be at levels last seen when Tony Blair was the Prime Minister. 35 to 40 bills is what we're expecting on everything from renewable energy to a national wealth fund to improvements around labour and workers' rights. All of those are going to be in the mix, as well as planning reform. Really important in terms of housing and the building out of key infrastructure like data centres. The opposition to Conservative Party, of course, will be going through all of this along with the Liberal Democrats as well, as it's debated after this speech. But the focus right now is what's coming through from the King as he sits there in the Houses of Lords within the Palace of Westminster.
Tom, so many governments have promised the same thing. Let's go through that headline again. The priority is planning reform and house building. How many governments have promised that and then failed to follow through? Why will it be different this time?
Yeah, a multitude of governments have promised that, as you know, John, of course, here in the UK, and they have failed to meet those targets. This Labour government is promising 1.5 million homes in this parliamentary period, so over the next 4 to 5 years. And your scepticism is very well founded. Here's what the Labour government would say is that they have that majority in the Houses of Parliament to be able to push through the concerns within those constituencies around adjustments to planning reform. They're not going to face the resistance, they would say, that the Conservative Party felt in the shires, in those greener areas of the UK where you have the NIMBYism is the critique that holds back much of this planning. They have the majority to look past those concerns, look past those complaints, readjust the planning procedures to push through with those housing targets. And they would also say that more importantly, or as importantly, it's not just about the building of houses, it's also about the building of that infrastructure, things like data centres that have been held back as a result of the rigidity within the planning system here.
Well, Tom, the other thing that the Labour government really campaigned on, and we're expecting to hear some flavour of it, is growth. But they're really hemmed in by the lack of fiscal headroom and that they're pledging to extend some of the tax cuts, or at least not increase taxes. What is going to be their platform for that growth when they can't spend their way to get there?
So I've talked about the parliamentary majority that this government has, but the flip side to that, in terms of the political strength that they have and this Prime Minister has, is the constraints on the fiscal side, as you correctly point out. Now, growth has been upgraded by the IMF. We saw that yesterday for the UK. The expectation you're going to get 0.7% this year. Well below, of course, the target that the Prime Minister has set himself for around 2.5% medium to longer term for the UK. How do you get there? This is a more interventionist government. This is an industrial policy that's going to be outlined in terms of what we're seeing with this state-owned energy company, for example, capitalised with about £8 billion, with additional private capital be searched for as well. Our state-owned wealth fund is also part of the mix. But the fact that this is an interventionist government with this industrial policy, and a government that has the ability to push through these policies, given its mandate unlike, for example, in the US, France or Germany, is what the government is saying gives them the ability to push for that ambitious growth. Of course, the OBR and others have suggested that that is going to be a challenge in terms of 2.5%.
Hey, Tom, great work as always, sir. Thanks for the update. Tom Mackenzie there of Bloomberg in the City of London as we get the King's Speech under the UK's new Labour government at the Palace of Westminster. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Major changes could be ahead for the Supreme Court. President Joe Biden is planning to unveil proposals that could dramatically reshape the High Court, including term limits on justices who now sit for life. The Washington Post reporting the president has also discussed an enforceable ethics code for judges and a constitutional amendment that would overturn the court's recent ruling offering broad immunity to presidents. Johnson & Johnson earnings just coming in. The pharma giant cutting its full-year profit forecast. Shares are lower, citing heavy costs tied to a series of recent acquisitions. But the company reporting second quarter earnings that beat Wall Street estimates on overall sales and medicine revenue. The company also saying it's, quote, cautiously optimistic about a settlement in its talc lawsuit. And Elon Musk saying he will relocate headquarters for X and SpaceX from California to Texas. Musk making the announcement on X after expressing frustration over California's new law related to transgender children in public schools. This coming after Musk earlier this week endorsed Republican Donald Trump for president and pledged tens of millions of dollars to his campaign every month. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, regional bank stocks absolutely surging.
On the regional and the smaller players, I think what you have is the cost of funds is beginning to crust. The expense leverage in this business is very good. We've seen banks much more efficient today than they were 15 years ago, John, and that's a tremendous difference.
We'll talk about that tremendous difference up next on the programme, live from New York City this morning. Good morning. Equity futures on the S&P look a little something like that. On the S&P 500, negative by 0.7% over the last 3 days. Firmer, positive. The big rally, though, coming from small caps. That continues this morning. The outperformance on the Russell versus basically everything else. The outperformance on regional bank stocks. Under surveillance this morning, regional bank stocks absolutely surging.
On the regional and the smaller players, I think what you have is the cost of funds is beginning to crust. Generally speaking, the expense leverage in this business is very good. We've seen banks much more efficient today than they were 15 years ago, John, and that's a tremendous difference. They still have to spend money, but I think they're much more efficient at doing so. So I think as we get to a period where the cost of funds comes down or at least flattens out, that's going to lead to better spread income.
So here's the latest. Regional and mid-sized banks surging amid growing optimism for Fed rate cuts, rallying more than 12% in the past 5 days. That's the longest stretch since the pandemic. Joining us now is Herman Chan of Bloomberg Intelligence. Herman, it's good to see you, sir.
Thank you.
What a move. What do you make of this over the last 5 sessions?
Yeah, the melt-up has been pretty extraordinary. I think there's a lot of enthusiasm for Fed rate cuts, as the previous guest had mentioned. And also there's expectations that if the Trump does become president, there's some potential for less regulation for regional banks, which would also bode well for them.
So 2 parts to that story, and let's start with interest rates. Mm-hmm. It's interesting to me that we're talking about 25 basis points maybe in September,
right.
Perhaps another one after that. We're not talking about a major rate cutting cycle that's going to stimulate all of this business for regional bank lenders. What are we talking about?
Right. The actual rate cuts will not have much of an impact for banks for 2024 results. That's definitely for sure. But there's lift in 2025, including potential for less credit quality issues that have been looming over banks ever since we've been sustaining higher interest rates. And there's also the potential for a higher loan growth as well. Loan growth has been pretty tepid over the past several quarters, and there's potential for that to come back with financing costs lower.
But have we seen any of that in the earnings we've gotten so far? Because there's been a lot of language of, for the small cap rally to continue, regional banks included, earnings need to show up.
Right.
Have they showed up?
I would say the earnings has been fairly stable. Nothing too surprise on the downside, but there's banks talked about, not only regionals like PNC yesterday, but also the largest banks like JPMorgan and Bank of America have talked about a strong earnings trajectory, especially in net interest income. So that's favorable for regional banks as well.
I want to talk about the other piece of what John mentioned, and that's the political piece. Having a VP pick who has championed local banks, but at the same time said that he would not recommend some of the big banks buying some of the smaller ones. There's a bit of nuance to it. So how does the political picture play out for these regional banks?
Right. One of the factors that has been really hurting the regional bank space, especially the smaller ones, is that there hasn't been a lot of M&A activity. And one of the reasons for that is that the Biden administration has been pretty reticent to approve deals, not only in banks, but also in other industries as well. So that's something that in a Trump administration, maybe that goes away. And you see more merger activity, which is good for increasing scale and increasing efficiencies for the regional banks.
This is where things get tricky, trying to work out how they'll actually govern. And that J.D. Vance pick kind of comes into the conversation too. So the senator from Ohio will address the convention a little bit later on this evening in Milwaukee, Wisconsin. And we know that the senator from Ohio has agreed on a lot of issues with Senator Warren, including this one right here on mergers and acquisitions. How business-friendly do you think this administration will actually be?
Right. I guess you can look back at the previous Trump administration, and you can see with the Fed there was a different regulator in terms of the banks, Randy Quarles, who was more open to having a tiered system of regulation for the smaller banks. So maybe you can sort of infer that if Trump does come into office again, that sort of behavior would change versus what's going on with the Biden administration with Michael Barr. So there's some potential blueprint for changing regulation for banks.
Herman, I got to ask, because in all of these, both in the Fed rate cuts and the politics, it's kind of, well, you need to infer, maybe there's potential there.
Right.
It's not there yet. Is there a sense we've gone too far in this rally?
Yeah, I think a lot of it's just vibes. We're seeing, the melt up, not really any changes in the actual earnings power of the banks, but it's really, the banks have really suffered since what happened with SVB in March of last year. And we've seen suppressed valuations and suppressed multiples. And now we're actually starting to feel like things are come back, the multiples are come back, fair values, more in play now for the regional banks versus a discount that we've seen over the past year and a half.
That is the most honest assessment that I think we'll hear for the rest of this month. A lot of this is just vibes. Dan Greenhouse of Solis sat around the table with us yesterday, and Dan made the point, how many people actually know what they're buying when they buy the Russell? What's in there? What do we own? Abercrombie and some regional bank stocks? Not to throw mud at some of the very good businesses out there, but I'm just talking about investors, Danny, pivoting from one thing to the other. How much knowledge do they actually have about what they're buying?
Well, also even the makeup of the Russell is so heavily skewed towards regional banks, which is also why we've gotten sort of this follow-on thing where the regional banks rally, because so much money has been poured into these ETFs, which again are a retail product. Would they be comfortable knowing that they're buying a bunch of regional banks? Would they be comfortable knowing that also in there is a bunch of unprofitable tech? You'd have to imagine if you dig through some of the actual components, maybe you wouldn't like what you're buying.
For much of this year, we were talking about regional banks and commercial real estate. Do the CRE issues go away with just a couple of cuts from the Federal Reserve?
The CRE issues don't go away, but you could think about, as I mentioned before, if there's lower borrowing costs, maybe the borrower can support these properties maybe a bit more than they would with rates elevated.
Herman Chan of Bloomberg Intelligence. Herman, thank you.
Thank you.
No doubt you'll be back soon to talk about this regional bank rally. It has been absolutely stunning. Coming up in the next hour on Bloomberg Surveillance, the lineup looks like this. We'll catch up with Michael O'Rourke of Jones Trading. We'll speak to Terry Haines of Pangaea Policy. We'll be catching up with Virginia Governor Glenn Youngkin, and we'll speak to Mike Schumacher of Wells Fargo. Let's talk about Glenn Youngkin. Danny was in the running to become the VP pick under Donald Trump. Didn't quite make it. He's sitting down with Anne-Marie in about 35 minutes' time. That is a business guy. That is a guy that's going to have very, very different views on some of these policies potentially coming out of this administration.
I'm going to be so interested what he has to say, because he's also been a guy that's been talking about Virginia. We want to get manufacturing back. We want to have more business growing up in this state. So what does he think about Trump's policies on tariffs? I'd be interested to know, because he's someone you'd probably associate with more classic conservative policies, not with the sort of protectionist ones that we hear from Trump. So in this idea of unification, does also the policy move towards unification? You can talk as much as you want about one Republican Party, but what does it mean when it could potentially hurt your constituents?
The thoughts on tariffs and the thoughts on foreign exchange dominating the interview with Donald Trump in Bloomberg Business Week this week. A fantastic read. If you haven't read it just yet, we've got a currency problem, in the words of the former president, Donald Trump. Right now, Japan has had a currency problem. Things are getting a little bit better off the back of those comments. Dollar yen with a move of 1 full percentage point. That is a stronger Japanese yen. We're trading here at 156.70. Up next on the programme, much more on this stellar, major, stunning small cap rally. Outperforming once again this morning with the S&P 500 negative 0.8% from New York. This is Bloomberg.
There's a whole large portion of the market that is both unloved and overlooked. And I think there's ample opportunity.
I think the market is now going to start to demand rate cuts.
Now would be optimal to recalibrate monetary policy now that the labor market is rebalanced.
We do think the Fed should be easing. We think they start in September, but we think they do cut 3 times this year.
Think how better the environment would be if we had lower short-term interest rates. You'd have more confidence in the country and in the future.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance begins right now. We need to talk about this conversation right here with Donald Trump, the former president, sitting down with Bloomberg Business Week. The top takeaways are as follows. He would keep Chairman Powell, allow him to complete the term. He doesn't want them cutting interest rates before November. That's not going to surprise you. Would consider Jamie Dimon for Treasury Secretary. You make of that whatever you want to make of it. The headline we're running with on this program is this one right here. Quote, we have a big currency problem. Question, Danny, what can they do about it?
Okay, well, the things that you could do about it are not great. One is you get a Fed chair in place who lets inflation run hot. The other thing, which directly contradicts some of his comments on Europe, is you do sort of a Reagan-style Plaza Accord. And for that, you need Europe on your side. And how do you get Europe on your side when you talk about pulling out of NATO because people aren't paying enough money, when you're angry at Angela Merkel because Germany hasn't bought enough U.S. cars, you want to increase tariffs? Is Europe really going to come to the table and help you weaken the currency?
I can think of one nation that might get on side, and that's Japan, maybe. Dollar yen, big move today. In fact, the dollar is weaker against everything in G10 at the moment. That's foreign exchange. We need to talk about equities as well. You might have noticed the S&P 500 pulling back by something like 0.75%. We've got a story out here at Bloomberg that, according to people familiar with the matter, the United States is floating even tougher trade curbs to try and crack down on exports of chips to China.
I think this goes back to what Herman Chan was saying, that it's trading on vibes, because we don't know what the government is going to look like in a couple months' time. We don't know if really the U.S.'s trading partners are going to go along with a chip crackdown if they think that the government might change. So instead, what we've had is this big rotation that some of it looks to be like a pain trade. Some of it looks to be like this huge amount of shorts on the Russell 2000 getting washed out. But then you add the politics into it and you really kickstart things. So it went from the S&P and tech just kind of hanging in there to now starting to break down.
We were talking about the prospect yesterday of a small cap presidency. No doubt we'll spend the morning talking about that too. A little bit later this morning, Anne-Marie from Milwaukee, Wisconsin, at the RNC. Look out for a conversation a little bit later. Equity futures on the S&P 500 pulling back then by a little more than 0.75% on the S&P 500. Elsewhere, we look like this in the bond market. Yields a little bit higher by a basis point or two at 417.50. There's another example of that dollar weakness we're talking about this morning. 109.31 on euro dollar. That currency pair firmer by 0.33%. Coming up this hour, we'll catch up with Michael O'Rourke of JonesTrading. He thinks the big rotation continues. Governor Glenn Youngkin on day 3 of the Republican National Convention sitting down with Bloomberg's Anne-Marie, and Mike Schumacher of Wells Fargo saying markets are too quick to price in a September rate cut. We begin with our top story, the Russell 2000 delivering massive outperformance as small caps rally more than 11% in just 5 sessions. Michael O'Rourke of JonesTrading thinks the S&P might get left behind. It is very likely the S&P 500 and NASDAQ 100 are in the process of registering their peaks for 2024. Michael joins us now for more. Michael, let's get into that, sir. Before we get into small caps, why do you think maybe the peak is forming, not just for the next few months or so, but maybe the rest of this year?
Well, as you know, the market has been crowding into these mega caps for the past 18 months, and that leadership got significantly narrower, I'd say, over throughout June into the first week of July. And of course, when we got that CPI report last week, it was the second, very cool inflation report in a row. And I think it is the type of number the Federal Reserve is looking for that's going to lead to that September rate cut. So when you think of what's gone on here for the past year and a half throughout this, high interest rate cycle, we got to this 5.375 level in the Fed funds rate last July. The market's crowded into these mega cap names. A lot of it has been size and safety. Of course, the AI trades there. So there's been a lot of positives that had this one-way crowding. These smaller cap names, the banks, as you guys were just talking about, these other groups' value, they've really massively underperformed. The S&P 500 equal weight also massively underperformed. And these are the other groups that are going to benefit from interest rates starting to move lower again. And investors are going to see there's going to be an opportunity there. So, I see people trading out of these what are now very expensive mega caps and looking for value throughout the rest of the market. And these other groups are trading at attractive valuations.
Michael, there's a reason, though, that they've traded at these valuations for the last year or so. They haven't put up the numbers. They've struggled with higher interest rates. And I think we're all trying to work out what difference 25, 50 basis points worth of cuts in 2024 actually makes the underlying business. I think we can all see the position squeeze, the trade of the last week. Hard to ignore it. We're trying to work out the fundamentals that need to back it up at some point. How durable are those tailwinds, Michael, through the rest of this year?
I think they're very durable, and it's more about the cycle shifting, right? We're going to start an easing cycle, and hopefully this era of high inflation the past several years is behind us. So if you look at the situation, you're saying, okay, it's been a rough 2 years for a lot of these companies. Going forward, the outlook should be better. I mean, the banks are the best example because we talk about the, $500 billion in unrealized held to maturity losses on their balance sheets that they weathered through the past, through the high interest rate cycle. That those are the factors that led to the SVB failure last year and things like that. Well, if these banks have survived that very tough environment, and now rates are going in the direction, they'll see less deposit pressure. Just as as you guys were talking about a little while ago, those multiples are going to start expanding again. That depression of multiples is going to end. So the outlook going forward for these groups is a lot better, and hopefully you see smaller companies begin to grow again. And of course, that's great for the country.
Michael, to your point, I mean, what really started this rally, what really gave it some juice was the CPI report. But then over the weekend, the events, really the bottom line coming from it was that Trump became a more likely candidate. And then you had the pick of his vice president, of J.D. Vance, which is champion smaller companies. And that's when you really get a leg in a rally that takes it to a record outperformance versus the S&P 500. How much of it is down to politics?
I think politics is a key part of it because, again, we this is a country where we don't want to see monopolistic companies, and that's kind of what's happened over the past 2 decades. You want to see small businesses, you want to see smaller companies grow. You want that American dream out there for everybody. So that's important. Now, you also have to remember the Russell 2000, it peaked in November of 2021. Through Monday's close, it had underperformed the S&P 500 by 32%. Since that peak. So we're just catching up for some lost ground here. And the group, that index is significantly landed. I mean, think about it. Apple, Microsoft, NVIDIA all have larger market caps than the Russell 2000. And if you have to remember at one point in time, those were all small companies themselves. So, I mean, you want to see that there is an era of growth coming, and hopefully we continue to shift in this direction.
Well, if you want to talk about making up lost ground, the regional banks, which you pointed to, have done exactly that. They are now back at the levels that they were before the SVB crisis for the first time since it happened. Is that fair, though? It's not like the office commercial real estate issue has gone away.
It hasn't gone away, but obviously it's been well advertised, and it's another one of those issues we've been dealing with for a couple of years now. I mean, that's the thing. If you can survive in this environment, in a high interest rate environment for a couple of years, as interest rates start to come down and you start a new easing cycle, that you should do even better. So I think that's the key. I think, and that's why, as you mentioned, that CPI report was so important because, I mean, throughout since the beginning of the year, remember, we started the year with the market expecting 6 rate cuts, which was ridiculous because we had 4% GDP in the second half of last year. Well, now we're seeing inflation come down in conjunction with the economy, but simultaneously the economy hasn't collapsed. So it makes these rate cut expectations we're seeing now much more plausible, and that, again, that whole new easing cycle just creates a better environment for those banks and those smaller companies out there.
Michael, later on this morning we'll catch up with Mike Schumacher of Wells Fargo, and Mike is talking about a window of maybe a month to 2 months for this to all work, and then the political considerations that Danny's talking about take over. I want to understand how you would respond to this kind of language from Donald Trump if he's president again. We have a big currency problem. What do you think that means to financial markets?
You know what? I don't see where we have a currency problem. 75% of non-farm payrolls in this country are service jobs, right? Our manufacturing base left a long time ago, and when China entered the WTO in 2001, it really got decimated. So, and again, obviously we're decoupling from China. We're heading in a different direction. We'll get some of that back. But what happened from that point on is we went from a 3-4% GDP country with strong jobs and stronger inflation to 2% GDP with less jobs but lower inflation. So you're talking about shifting the makeup of the economy. It'd be nice to have more manufacturing jobs, but it's also going to lead to more inflation. And again, it's a massive shift when we talk about 75% of the jobs in this country, non-farm payrolls are service jobs. So I don't see it quite the same way, but it should be interesting to see what he plans to do about it.
Well, Michael, that would be my question as well. It doesn't really matter how you and I see it. What really matters is how he sees it and what he's willing to do about it. Do you think there would be a preference for big caps over small if there is something they can do about it?
I think there'd be a preference for manufacturing to come back. I think that's what you're going to. And of course, we've started that a little bit as far as we're trying to build semiconductors in this country now and things like that. But it is it's a structural shift in the U.S. economy that we're so far from that taking hold. It's hard to say. Obviously, I do think if you have a weaker dollar, U.S. stocks do rally. They will perform better, but there's a give and take there on the global scene. I mean, what we've seen happen in Japan, I would argue it's not, yes, their stocks are at new highs, et cetera, but they've decimated their currency to do that. I wouldn't argue that's good policy. But again, a lot remains to be seen. But yeah, a weak dollar would be good for stocks.
Got a weaker dollar this morning. We're down 0.5%. Michael, thank you, sir. Michael O'Rourke there of JonesTrading. All these points of tension that we need to figure out over the next 4 months and maybe beyond. Equity futures right now down by 0.9%, near session lows. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. The new UK Labour government vowing to pursue Britain's most ambitious planning reforms in decades, unveiling a wide-ranging legislative program at the King's Speech at Westminster. The speech announced 39 bills in areas including renewable energy, house building, and artificial intelligence, in contrast to 21 bills unveiled by Rishi Sunak's government at the last King's Speech in 2023. King Charles saying, quote, "It is my government's objective to see rising living standards in all nations and regions in the United Kingdom." New Jersey Senator Bob Menendez was found guilty of bribery, extortion, and acting as a foreign agent of Egypt. A jury found that the powerful Democrat had accepted gold, cash, a Mercedes-Benz, and other gifts worth hundreds of thousands of dollars in exchange for numerous political favors. Senator Menendez remaining defiant after the verdict, despite calls from Majority Leader Chuck Schumer and New Jersey Governor Phil Murphy to resign. The 70-year-old faces the possibility of years behind bars. And shares of Roche are higher after the company said its weight loss pill showed promise in a study. The Swiss pharma company said obesity patients who took its experimental pill lost an average of more than 7% of their starting weight, compared to with a little over 1% in patients who took a placebo. Shares gaining the most in over 4 years as Roche says the drug will move into the next phase of development. That's your Bloomberg Brief. John?
Yahara, thank you. Much more from Yahara in about 30 minutes' time. Up next on the program, Biden not backing down.
Jobs are up. Wages are up. Tourism is back. The economy is growing. Inflation is down and continues to go down. We have to do more. That's why I'm determined to finish this job.
That conversation up next, live from New York City. Good morning. Session lows here on the S&P 500, down about 0.9%, pulling back. A couple of things going on here, but here's one, and we'll be talking about it in just a moment. The United States floating tougher trade curbs and a chip crackdown. We'll get into that in just a moment. Yields up by a single basis point, 417.30 on a 10-year. Under surveillance this morning, Biden not backing down.
Jobs are up. Wages are up. Tourism is back. The economy is growing. Inflation is down and continues to go down. The economists tell us his plan would cost working families a new tax of $2,500 a year. We can't let that happen. We have to do more. That's why I'm determined to finish this job.
It's the latest. A growing faction of Democratic lawmakers renewing calls to replace President Biden on the ticket, pushing back against DNC plans to fast-track his nomination. Several House Democrats signing a letter arguing there is no legal justification for an early roll call vote just 2 weeks before the convention begins. Joining us now is Bloomberg's Anne-Marie. AMH, let's get into this. The pressure on President Biden seems to have fallen away just a little bit. Can he get this done?
Well, here's the issue, Jonathan. He had a bit of breathing room following what happened over the weekend, this attempt assassination on former President Donald Trump. His party did give him some time to come out, talk about that. But now that anger, this unnervingness, this basically what they're so stressed out about is that can Biden get them over the finish line November 5th? That pause is starting to stop. And we're seeing in some reports as well that a letter is going around and potentially more Democrats want to put their name to it. And they're upset by the fact that the DNC wants to push up this roll call vote, basically lock in Biden as soon as possible. This is why he continues to hit the campaign trail. But these questions about his age and can he do the job, they are continuing to linger. And now that he's had this breathing space in a few days, an interview, he's on the campaign trail, he was in Nevada, that hasn't quelled their concern. And that just means that this effort may just start to ramp up even more.
It's interesting, Anne-Marie, because you've seen some policies start to come out of the Biden White House. You have this one on chips, more severe curbs. The Washington Post also has a story this morning that Biden is considering Supreme Court reforms, that is term limits and ethics codes put in place. But is any of that policy, or at least desired policy, breaking through the noise?
Well, first, there's been a lot of individuals in the progressive wing of the party who've been calling for this, and Biden did not want to go through with it. It feels like almost a Hail Mary effort. And also, he cannot do this before November 5th. So this is just straight politics playing to his base, trying to shore up members of his own party within the Democratic Party in July, ahead of their convention in August, ahead of an election in November. So all of this is really him trying to really talk to the individuals in his own party to not just talk about the policies that he would enact in the next 4 years, but to give them confidence that he should still be the top of the ticket.
AMH, looking forward to your conversation with the Virginia Governor, Glenn Youngkin, in about 10 minutes' time. Do not miss that right here on Bloomberg TV. Joining us now to continue this conversation is Terry Haines of Pangaea Policy. Terry, we can drown in campaign politics, but I'd rather talk about policy with you, sir. This quote from Donald Trump, the former president, to our team at Bloomberg Business Week, that we've got a big currency problem. I think a question that a lot of people around this table already this morning have had in the last 90 minutes or so. Terry, what can they do about it, even if they get back into power?
Well, I think what they'll probably end up doing is trying to put a policy mix into place that strengthens American defense, including the ability to supply our allies and provide a lot of manufacturing reshoring. Continue to support semiconductors, do a bunch of those things. But I look at this as much more rhetorical than real. It's not as if they're going to have a strong dollar task force. There's just too much. There are too many variables involved here.
Terry, of the campaign agenda, what do you think is more real? What should we be taking more seriously?
Well, I think you should be taking seriously let's put it this way. A lot of the business about protectionism versus conservatism, that's real, but there's to some extent that's noise within the party. The bigger reality, I think, that's been going on for the last 8 years, and I would point to Obama's decision not even to try to get the Trans-Pacific Partnership ratified in 2016, is a greater turn towards shoring up manufacturing and defense and the like. That's really what's turbocharging policy underneath all of this. That's happening with Biden right now. And as you've referenced a couple of times this morning, they're also looking at bigger chip manufacturing restrictions or export restrictions. So you get a situation where the Trump versus Biden focus is really a matter of degree more than anything else. Trump's expressing what he wants to do more vigorously and with more energy, but it's broadly the similar policy.
Okay, but what about things like foreign policy? When he says things to Bloomberg Business Week, like on Europe, they treat us violently. Taiwan took our chip business from us, talking about why would we necessarily support them if China invades? How seriously should American allies take these?
Well, I think it's wise to take the adage, Selena Zito's adage of take Trump seriously but not literally in hand. If Trump was a painter, he'd be Jackson Pollock. He wouldn't be a literalist, I think. But he's splashing the paint cans around all over the place. But in point of fact, look, what the allies know is that the NATO criticism was always based in the lack of the monetary support for the alliance, and that's being remedied now, number one. Number two, Trump can't leave NATO unilaterally, both because of the 1949 treaty and because now there's a law in 2023 banning the president from doing it. So, in reality, you're going to get a lot of discomfiture on the side. And the allies, of course, still, by and large, take the position in Brussels cocktail parties and the like that, they find Trump distasteful. But in the end, I think what you're going to see is very strong support for allies, very strong support for the alliance.
But presumably a lot of this will change depending on who he puts in his cabinet. We know one person already for his vice presidential pick, J.D. Vance. I mean, looking at that and looking at who he might choose, does it give you comfort that he might be backed off from the most extreme of some of his views?
Well, I've always thought that Trump, in practice, ends up being a whole lot more sort of centrist and business friendly than Trump rhetoric, which is meant for campaigning and for pressure and for leverage. I mean, to me, the most significant part of your excellent interview was exactly that he uses tariffs as a negotiating tactic, which is obvious if you're looking closely, but at the same time, tariffs scare the willies out of people. So and it's a point of contention between the two. Even if it's mostly by degree, considering where Biden is on this, but I find him much more centrist in practice, and you wouldn't have gotten the endorsements you would have from the Ken Griffins of the world were that otherwise.
Terry, let's talk about something much scarier than tariffs. The reporting yesterday from here and elsewhere that there was an Iranian plot to assassinate the former president, Donald Trump. Terry, what kind of changes on the foreign policy front could we be looking at here? And if that story is true, what is Iran so afraid of?
Well, I think what Iran's afraid of is a foreign policy that is more laser focused on taking them out. I mean, as a major player in the Middle East, I mean, we all understand what's going on in the Middle East, which is that Hamas attacking Israel and all the rest. But the broader struggle here is whether or not you're going to have an ascendancy of Iran and the proxies versus kind of Israel, Saudi, Jordan, and a number of more conventional folks who want peace in the Middle East. And Trump's going to be much more focused on that. And the concern is from many in the United States, and clearly what Iran sees is that it can use the disarray in the Biden administration and the lack of resolve in the Biden administration to its advantage.
Shocking story out yesterday. Terry Haines, Thank you. Terry Haines of Pangaea Policy on the policy effort for both President Biden and Donald Trump. Equities right now near session lows. We're down about 1 full percentage point. Coming up next on the programme, do not miss this sit-down conversation. Anne-Marie with Virginia Governor Glenn Youngkin at the RNC. Now, what we heard from Donald Trump in our Business Week conversation was that he would be considered, or at least considering, the likes of Jamie Dimon for his Treasury Secretary. Could we see a Governor Glenn Youngkin in the next Trump administration if we do indeed get one?
Well, he was floated at one point as a vice presidential pick, so clearly that sort of thought process has been there. But if he's trying to assemble a cabinet of businessmen, hey, Glenn Youngkin, previously of Carlisle, why not?
Youngkin and Hordern from Milwaukee, Wisconsin, up next on the programme. Futures near session lows. We're down 1 full percentage point on the S&P 500. Once again, we've seen this story again and again and again on repeat over the last week. Small caps outperform on a relative basis. From New York, this is Bloomberg. We have got a lot to navigate this morning, so let's start with the equity market. On the S&P 500, down by 1 full percentage point. The underperformance, once again, is coming from the NASDAQ 100. Small caps not spared, just some relative outperformance. We're down only by 0.75% after a pretty stellar rally over the last week or so. Let's talk about that NASDAQ move. We've got Nvidia down by more than 4 percentage points in the pre-market. Largely off the back of this story this morning, Danny, the Biden administration, according to our reporting, has told allies it's considering using the most severe trade restrictions available to crack down on some of these chip-related companies.
Well, and there's a great rotation that's happened. It's been more about the attractiveness of the small caps that have been left behind. The story hadn't really been about the big cap tech before. Maybe they got bid up a lot, but there's no fundamental change to the story. There were still strong hands on it. This could potentially be a fundamental change to their story. So you're finally starting to see cracks in that.
That's the equity picture. Let's talk about the bond market. Yields are up at the front end by 4 basis points. The 2-year up to about 446.11. You might think off the back of a move like that we'd get a stronger dollar. You turn the page and switch to the board and get to foreign exchange. We've had a weaker dollar through most of this morning. Dollar yen down by 1 full percentage point to 156.60. Let's talk about foreign exchange. Under surveillance this morning, the dollar facing pressure among G10 currencies. The Japanese yen falling to the lowest level since June 13th. Sterling rising to 130 after a surprise inflation print. And Donald Trump telling Bloomberg Business Week, we have a big currency problem, raising bets that a new administration would weaken the US dollar. The question we've got, Danny, is how?
Exactly. How would they do that? Is it through a Fed chair who allows inflation to run hot? Is it through a Plaza Accord? Or is it through the threat of tariffs? Maybe there's this idea that if Trump looks at Japan and says, hey, your currency's too weak, we're going to slam you with tariffs, maybe they kind of speed up that hiking cycle a bit. And I think that's kind of what's starting to get priced in.
It's kind of the one country right now that would get on board with having a stronger currency at the moment, right? Like dollar yen down by 1.1%, 156.60. I want to turn to this story just briefly. President Joe Biden set to call for a major shift to the US Supreme Court. A person familiar with the matter telling Bloomberg Biden will propose adding term limits for justices. The call also including an enforceable ethics code as Biden looks for more appeal to his campaign. I think this is very much about his campaign going into November. I want to turn to this story too. Donald Trump also telling Bloomberg Business Week he's open to letting Fed Chair Jay Powell finish his current term. Trump also floating Jamie Dimon to a possible pick to lead the US Treasury. To continue this conversation, Anne-Marie is at the RNC in Milwaukee, Wisconsin with a special guest. AMH, over to you.
Thanks so much, Jonathan, and good morning. Donald Trump has called him prime time. It's the governor from Virginia, Glenn Youngkin. Thank you for joining me here at the RNC in Milwaukee.
Good morning. You know, I have to say that the Republican National Convention, as we move into day 3, has been a real statement. It's been a statement about coming together and excitement. And when President Trump came into the arena on Monday night, and it's the first time that everyone had really seen him since the assassination attempt, the place erupted, and it was emotional. And I think it does represent not only confidence in the America that he built last time, but the one he can build again.
So would you go work for him? Because he says he'd love to have you on the team.
Well, it's an incredibly humbling sentiment. Let's be serious. Right now, the job is to win. And Virginia's in play, which is amazing to say. Joe Biden won Virginia by 10 points last time. And then we came back and won by 2 the next year. And all the polls have Virginia locked up tight. So I'm going to go to work to one, be a great governor in Virginia, and then second of all, make sure that we do everything we can for Donald Trump to win.
So is there a sense if you flip Virginia and it goes red, you would join this administration? If you were asked to serve your country under President Donald Trump, would you join?
There's so many ifs there. Let's just start with the work at hand. And I'm a pretty basic businessman who's become a governor, which is set objectives and let's go meet them. And we set the objectives in Virginia to turn around Virginia's job growth and economy. And we've used all of the tools that we know work. We have had $5 billion of tax relief. We've streamlined regulations in a big way. We've built a great workforce and we've invested in our infrastructure. And, we were just ranked the top place for business. And that's because we really are the top place for business. So my job's really straightforward. Set objectives. Let's go meet them. One of our objectives is to make sure that our congressional candidates win in Virginia, that we extend our majority in Washington, and to help Donald Trump win Virginia.
You mentioned your business acumen. You were part of the business world, the head of Carlyle. What I was hearing is that a lot of individuals on Wall Street were calling the former president, asking him to pick someone like you. Instead, he went with J.D. Vance, someone that sometimes unnerves Wall Street. He's a protectionist individual. He's a populist. He's calling for tariffs. One of your biggest importers coming from China. How do you think Virginia would handle, say, 60% tariffs on China and a 10% tariff ring around the United States?
Well, let's first back up. I think one of the things that President Trump has been clear about, and we know in the business community, is that free trade really doesn't exist because we've given unfettered access to the U.S. market, and so many other countries actually don't provide reciprocal access to their markets. And let's be clear, U.S. companies do not have access on an unfettered basis to the Chinese market, and yet they expect to have unfettered access to the U.S. market. And so we've got to stand up strong for the United States. On top of that, China is not just a rival. They're trying to dominate the world, and they're trying to do it at the expense of the United States. They use economic imperialism to do it. They saber rattle, and on top of that, they use every ounce to infiltrate every bit of the U.S. Economy to understand how they can influence it. What that has translated to is a real recognition that we need to not only protect ourselves against China, but we need to fight back. And so the tariffs that President Trump imposed on China when he struck the first Chinese deal were critical in order to rebalance an unbalanced situation with China. And companies that are doing business in China, take Ford, for example. I mean, here's Ford, who has a big market share in China, and then they want to build an electric vehicle battery plant in the United States. And I can guarantee you that the Chinese government put immense pressure on them to use cattle technology in the United States. And now we're seeing that cattle technology is being banned by the U.S. military because they're worried about the influence from the Chinese Communist Party. I mean, this is the way China does business, and we've got to make sure that we're fighting back.
Most economists, though, say tariffs are inflationary. So do you think that's the right solution to this problem you don't think is currently free trade on the marketplace?
Yeah, I do have to begin with, I have lots of economist friends and worked with them for a long time. And
well, the Peterson
economists
says
are right and wrong.
$1,700 per every household. They ran all the numbers.
Well, I know. People ran lots of numbers at the beginning of the year and said there was going to be 5 rate cuts this year in the United States. Come on, let's be real. At the end of the day, I believe that President Trump will use tariffs in order to make sure that trade is reciprocal and fair. Fair for the United States, fair for U.S. businesses, and fair for the U.S. worker. And that's really important.
He also thinks the dollar is too strong. Do you think we have a currency problem?
Well, I think the first issue we have with our currency reflects the lack of strength, the weakness that the Biden-Harris administration has projected economically around the world. And a weak America invites a strong China. And China has moved right in around the world economically. And all of a sudden you hear once again all of these threats that the dollar will not play the role that it has internationally going forward, that it has historically. That's a real challenge to the U.S., and it's a real challenge to our economic future. So I think that part of the reason why the electorate in Virginia and around the country are excited about President Trump coming back into office is strength. Economic strength, national security strength, border strength. They're tired of a weak America. They want a strong America.
But how do you think he actually fixes that dollar problem?
Well, first of all, having an economy that actually works.
But that might mean a stronger U.S. dollar. Like, a lot of people are looking at what these potential policies could be, especially protectionist trade policies. And they would say, that looks like it's going to be a strong dollar.
Well,
Does the Fed need to get involved? Does the Treasury need to, maybe buy other foreign currencies?
Well, let's go back to core basics. A strong U.S. economy that does not have runaway inflation which is what the Biden-Harris administration unleashed on America. Unprecedented inflation. We haven't seen it for decades. That drives a dollar up because interest rates have to follow. And Jay Powell's done a really good job combating inflation. Let's be real. I mean, beginning of the year, there was huge pressure for 5 rate cuts. And of course, inflation was nowhere near contained. And he's done a really good job maintaining discipline. We've got to get inflation down, make sure that it is, and then rates will come down and rates will drive the currency. And that's a strong, high growth, low inflation economy that is not allowing inflation to drive too strong a dollar.
Well, you said earlier the market was expecting 5. Now the market expects 1 or 2, one of them likely before the U.S. election. Do you think Jay Powell, if he is to cut rates for the U.S. election, is being political?
No, I don't. I think Jay is doing his job. And as we have seen the Biden economy really falter, Jay's going to react, and he's going to do what he needs to do. And so, no, Jay's not political at all. Jay's doing a great job.
J.D. Vance is the VP pick. I want to give you a quote of what he put on his campaign website, black and white, before he ran for the Senate. We're going to raise taxes on companies that ship jobs overseas and use their money to fund anti-American radical movements. Does corporate America have a place in this Republican Party?
Well, first of all, let me begin with JD's nomination. I think he's going to be a great running mate for the president, and I think he's going to do a great job as vice president. And let's be clear, it is Donald Trump's agenda. And Donald Trump is going to set the agenda on the future of our economy and how we are going to build a rip-roaring economy again, just like the one we had in his previous administration. And yes, the business community clearly is excited about this. Listen, the stock market ran away over the last few days as it's become more clear that Trump is leading and has a better than likely chance of being elected as president. I also think it reflects the catastrophe that Joe Biden has been over the last couple of weeks coming out of the debate for the Democratic Party. I mean, there's chaos on their side. And Wall Street and the markets and business seem to really support this because the market's running away. That's really exciting, I think, for the opportunity to build a strong economy, a strong America, and to put us back where we belong, which is leading, as opposed to really defending weakness all the time.
Besides Elon Musk this week, though, no Fortune 100 CEO has come out and publicly linked themselves to back former president in donations. Do you think that's a problem?
Well, let's just start with Elon Musk, and you can't just dismiss Elon Musk. I mean, this week he made an enormous statement,
But there's 99 others.
$180 million in order to support grassroots ground game efforts to elect Donald Trump in 7 battleground states. I mean, this is a giant statement. And I think we'll see over the course of the next 3.5 months, as it becomes very clear that the momentum that we're seeing today can be maintained, that the business community does want a strong economy. They want a strong leader in Washington. They want America to be strong overseas. They want a secure border. We need to combat China, not placate China. And this is what Donald Trump's going to represent. And this is why I think American business will be very pleased to have him back as president.
You spoke to Trump before you gave your speech at the RNC at the convention center. What did he say to you?
Well, I called him on Sunday after the assassination attempt. And let's just be clear here. He was millimeters away from a very different Sunday than what we had. And I do thank God for his presence there, because evil was unleashed in Pennsylvania. And he said that he was changing his speech. And he said he was encouraging everyone else to do the exact same thing, to really reflect on unity in the Republican Party and unity across America. And this is the opportunity we have, which is to bring people together around a common vision that unleashes the land of opportunity once again, as opposed to one where the most Americans have been so concerned economically. Can they write the tuition check? Can they retire? As runaway inflation has really eroded so much of their hard work.
Inflation has come down, but certainly it is top of mind for a lot of American voters with those prices.
We got to be real. Inflation has come down from highs that were unprecedented. And it is the cumulative effect of inflation that has made prices so high. Grocery prices up 30%, gas up 40%. For the average American family, this is really, really tough. Listen, prices aren't going down. They're just going up less quickly.
That's correct. Glenn Youngkin, thank you so much for your time. That was, of course, the governor from Virginia, Glenn Youngkin, who Donald Trump says is prime time and would love him, Jonathan, in his administration.
Is that his new name now? We're calling him prime time. Anne-Marie, thank you. Looking forward to more from Anne-Marie later this morning. That was prime time. Let's talk about a big theme in that conversation, China. If we can't get access there, why would they have access here? Kind of makes sense. Reciprocity. Strong argument, really strong argument. But there's a new layer here. And it's sort of dominated, I think, policy over the last several years. A lack of trust, national security. There are industries that we want here that we do not want there, regardless of how accessible it might be for American companies.
Right. And you can really feel that in just when you talk about EVs and the exorbitant tariffs they're putting on those to make sure they don't come in the country. When Reagan was president, Japan was in the same situation where Japan was turning out cheap cars. America basically said, fine, but you come here and you build them here. That's not happening this time. And largely it's because of that security piece. So that the way that we really approach overproduction has changed than it was in the past.
Much more on this conversation throughout this morning. I just want to touch base on equities. Down across the board here, small caps as well. Quite a sell-off. We're down about 1 full percentage point on the S&P 500. In the face of a big run-up over the last week on small caps, we're down there as well by a similar amount. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Sticking to China, the Biden administration is considering ramping up its chip crackdown on China. Bloomberg learning that the U.S. has floated using the most severe trade restrictions available if companies such as ASML continue giving China access to advanced semiconductor technology. The potential risk hitting shares of ASML even as it posted second quarter earnings and sales that beat estimates. Adidas shares jumping to a 2022 high, the sportswear maker raising its annual profit target for the second time in 3 months. Adidas riding a wave of popularity as demand soars for its retro Samba and Gazelle sneakers. Plus, it's selling more Yeezy sneakers, shrinking its stockpile of the shoes, which it has stopped making after cutting ties with Kanye West. And Cathie Wood is making a bold call on Tesla, the ARK Invest CEO, saying the company's move into the autonomous taxi business will be a catalyst for a roughly tenfold increase in its share price. Woods has been bullish on Tesla for a long time, making it a top holding in her ARK Innovation ETF. Tesla shares are up 3% this year, while Woods Innovation Fund has lost nearly 9% this year. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, the market says September.
There is a lot of uncertainty out there, but for now, we're expecting the curve to steepen. There is a good case that the Fed should be easing policy. The idea that policy should be less restrictive when the labor market's slowing, when inflation's coming down to target, I think that makes a lot of sense.
It's a question that Jan Hatzius of Goldman asked at the start of this week. Why wait? Why wait? We'll ask that question next. From New York, you're watching Bloomberg Surveillance. Got a bit of a sell-off here. We're down across the board on the S&P 500, down by close to 1 full percentage point, following a 3-day winning streak. Seen lots of pressure on the Nasdaq over the last week. We're down even more this morning by 1.5. The difference today? Small caps joining in. After a 5-day run, double-digit percentage point gains. We pulled back by just 0.6%. Under surveillance this morning, the market says September.
There is a lot of uncertainty out there, but for now, we're expecting the curve to steepen. There is a good case that the Fed should be easing policy. The idea that policy should be less restrictive when the labor market's slowing, when inflation's coming down to target, I think that makes a lot of sense. We do think the Fed should be easing. We think they start in September, but we think they do cut 3 times this year.
Here's the latest this morning. Fed President John Williams telling the Wall Street Journal that currency policy is appropriate until he sees more data. More Fed speak on deck from Barkin and Waller ahead of the beige book at 2 p.m. Eastern Time. Mike Schumacher of Wells Fargo saying this. The Fed is likely to move in September, but this market is pricing too high a possibility it will happen. Mike joins us now for more. Mike, you framed this quite well. The two countervailing forces right now in the bond market. One is the interest rate policy of the Federal Reserve, not the currency policy. And the other is the political considerations taking place later this year. When do you start to consider one over the other?
Yeah, it's been really interesting, John. We've had a ton of questions about this, as you can imagine, for the last couple of weeks. And really, I think the Fed dominates over the next few months. And we've seen this really over the last couple of years. Markets have fixated on monetary policy, but you can't ignore the politics. So I think in terms of sequencing, the Fed's probably the dominant force until, call it early November, then politics really kicks in. So I think the big move we've had in the last, call it 10 days, the Trump trade, it's about done for now. It'll reassert itself, but we do think it's run its course for the time being.
It sounds like, Mike, that you want to be super tactical. Is that right?
That is right, and I think that reflects not just our view, but also when you think about the comments out of the Federal Reserve, I would characterize them as tactical. They don't have a lot of confidence in their long-range modeling ability. That's why they want to wait. A lot of people are saying, gee, inflation data are cooperating, why not go now? And the reason for that is because the models have been so far off so many times, they want to wait until they see more evidence. So wait, get that opportunity, then go.
Mike, related to this, I mean, it's been a really good year where a winning trade would just be fading any macro extremes from 6 cuts priced in to no cuts priced in. But here we find ourselves with 3. And you got at this a little bit, but what extremes still exist that I should fade at this moment?
Yeah, a couple of things could happen. I think the big risk out there for markets in general is that inflation finds a home, but it's too high. Whether that's in the U.S., whether it's in the Eurozone, the U.K., you name it. Yes, inflation's come down, that's great, but it's not yet to a level of policymakers like maybe it gets stuck or maybe there's a U-turn. That's the really nightmare scenario for markets out there. And with respect to politics, I think there's always a risk that things get overcooked even further. So maybe there's total chaos at the Democratic convention next month in the U.S., or maybe Donald Trump says something really wild on Thursday night. These things can spur a bit of a reaction too. So I would really watch for the inflation idea first, so inflation gets stuck at an untenably high level, and the political side second.
That political side, that sort of scenario that you're describing with more chaos, more concern there, what even would yields do then? Because I'm not too sure listening to you, because I said, okay, you're concerned, maybe I go out and buy treasuries, or maybe you think, I don't know, just government spending in general, you got to sell them. How does that sort of thing play out?
Yeah, so our view is pretty simple. We think the yields go down somewhat modestly over the course of the year. So take the 10-year Treasury, for instance. Today it's at 415, 420, that sort of ballpark. I think by the end of the year, you're looking at high 3s. So a decent move down, but not a ton. And the question for us is how much of that big Fed move. So our thesis for a while has been when the Fed eventually cuts, the market will price a lot more easing. That'll drive what people call the typical Fed cycle trade. Yields down, curve steeper, everyone's happy. That gets offset somewhat if there is a sweep in November. So our take on it is you want to be long duration to some degree, not a huge degree, over the next few months, and look to go the other direction or go more neutral, call it, maybe around November 1st.
But if yields really get going after the first cut, Mike, is that not something I'd want to fade, considering this is an economy that's holding up? It doesn't look like a rate cutting cycle that's going to be of one's past. It's that sort of mid-cycle adjustment, that tweak that many people have called it. Is that really enough to sort of power that type of move?
Yeah, a couple things there. First of all, I don't necessarily buy the mid-cycle adjustment. Secondly, what really counts here is not what the Fed does or the ECB does. It's what the market thinks the central bank will do. This is a key point. So if you look at the last, call it 30-plus years of cycles, for the Fed, the average move in the first 12 months is about 260 basis points of easing. It's huge. In the market today, if you look at September this year to September next year, is pricing about 130. So our point to clients is, look, the market's very unlikely to price 260-odd basis points of easing. We get that. But after that first cut happens, people say it's game on. We shouldn't be pricing 130. Maybe we price 175, or maybe we really get going and price 200 basis points. But there's a lot of additional pricing relative to current forwards that can happen. So the Fed does not have to deliver those cuts. It just has to get the market thinking, hey, the Fed's moving that direction. We, the market, are being too conservative. We should price more. That's really the thought process we've been talking about with clients.
Mike, I just want to finish up with focusing on the longer end of the curve, 10s plus. I want to understand, Mike, if we start to see high yields off the back of a Trump Volume 2, a second term for President Donald Trump, whether those high yields are a function of inflation expectations, growth expectations, pricing in a Fed that's higher for longer. Danny touched on this, but I'm really trying to work this out from the equity perspective. From an equity perspective, what do I do with that? Is that because it's better growth, higher inflation, higher rates? What is it?
The main reason we think that yields are actually going to rise, and fundamentally, John, the bigger view we have is the curve will steepen, let's say 10-year versus 30-year, is the fiscal deficit becomes worse. So let's say there is a Republican sweep. Probably the Republicans go after the tax code, extend the Trump tax cuts, maybe increase them, who knows. That's going to increase the toll on Treasury funding, a lot more funding, steeper back into the Treasury curve, probably pushes rates up somewhat. So I think it's really call it the fiscal spend, if you will. It's that fiscal pulse. So it's not a weak economy. It's not necessarily inflationary per se.
Got it.
It's simply a lot of additional bond supply coming to market.
In 20 seconds, does that generate the weaker dollar that he's looking for?
Weaker dollar, I agree with Governor Youngkin. It's the Fed. Once the Fed comes in, once the market prices a lot of additional easing, that rate differential comes down. That should drive the dollar quite a bit weaker.
Got it. Mike, thank you, sir. Mike Schumacher there of Wells Fargo on a rates market. They're all trying to work that out. If it's all about supply over the longer end, typically you'd say high yield, stronger dollar. Got all of that. But if you start to worry about the deficit and people financing it, does that start to generate that weaker dollar? That's something we didn't see in the last 12 months.
And I also think what it does to equities is a really interesting point, too. Do they care? History has shown us, recent history, that they don't care about higher yields.
Let's see if they do care. Coming up next on the programme, Phil Camporeale of JPMorgan and Michael Halen of Bloomberg Intelligence will catch up with Tony Rodriguez of Nuveen and Brian Weinstein of Morgan Stanley. The third hour of Bloomberg Surveillance up next.
Donald Trump is doubling down on his brand, that blue wall, which is, quite frankly, President Biden's best chance at retaining the White House.
I think this is a market that's pulling forward a Trump win.
A lot of the Trump effect is starting to be priced into markets already.
The tariff story is probably going to be the big one that we have to wrestle with.
Those tariffs do raise a lot of inflation uncertainty. And again, it will complicate the Fed's story, the Fed's message.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
OK, let's get straight into it. The schedule is a little bit light today. So on the schedule, 8:30 Eastern, about 30 minutes from now, you'll get some housing starts data. That's the data. Here's the Fed speak. You'll hear from Barkin and Waller. You'll get the Beige Book as well. We heard from John Williams, the New York Fed president, speaking to the Wall Street Journal, suggesting we're getting closer, but we're not there yet. Maybe taking the July story off the table. And then later on at the RNC, Senator J.D. Vance, VP pick for Donald Trump. He will be speaking a little bit later on this evening. That's your day ahead. We need to talk about the here and now. Equity futures pulling back on the S&P 500, about 90 minutes away from that opening bell. If you're looking at futures on small caps, the Russell's been doing tremendously well over the last week or so. This morning, though, Danny, I've got to say, small caps pulling back as well. So this is a sell-off across the board.
It really is. I'll be interested if this picks up with some steam because it has been a resilient market, maybe a complacent market, depending on what word you want to use. The S&P hasn't sold off more than 2% in a day in the longest stretch since the financial crisis, more than 350 days. So there's a sense that while this rotation has been going on, it's strong hands underpinning it. It's not the weak hands that fold, that sell off big tech. Something feels a little bit different in today's market. So if it picks up some steam, I'll be interested to know whether a lot of concentration in those big names that we've been worried about, whether it actually plays out, because it hasn't been.
The three pillars I think we've all been navigating. One is rate policy at the Federal Reserve. That's linked with two, what the economic data, the economic output, inflation mix looks like right now. And the third is, and that's separate, political considerations, the politics of the last, I'm going to say 2 or 3 weeks, going back to that debate a few Thursdays ago with Biden and Trump. Since then, we've been talking about the Trump trade in a much bigger way.
Just to play devil's advocate, I'm wondering if all this is just more certainty in who the president is or the president will be. You have to imagine that if you were to do a contrarian portfolio and say, okay, I'm going to assume that Biden is going to be the president next year in 2025, how different would it really be? I wonder if it's just like, look, we have more certainty that we're going to get someone, that what's been a really tight, close race is starting to lean one way. Maybe if you're a business, you can start to spend, you can start to do CapEx. Maybe underneath the surface, things look a little bit different, but maybe all you needed was some certainties to really get a rally going.
Have we got that certainty right now? This morning, at least, we're pulling back. We're down by about 1 full percentage point on the S&P 500. As I say, a little bit of outperformance on the Russell again this morning, but the big outperformance of the last week is what's dominated the conversations on Wall Street. We'll talk more about that in just a moment. In the bond market, yields are higher by 2 basis points on a 10-year, 417.88, and the dollar is a whole lot weaker. Euro dollar 109.34, dollar weaker against everything in G10. A sit-down conversation with Donald Trump and Bloomberg Business Week, and the big takeaway is, here's the quote, "We've got a big currency problem." That's a quote you're going to hear a lot in the next few weeks.
Yeah, and again, it's a currency problem without a solution, at least without a solution, considering the policies that he wants to put on place. He wants to extend the tax cuts. Okay, a higher deficit. Okay, you want to add tariffs in, more inflation in the U.S. All of those, even though he's not pro-dollar, those are pro-dollar policies. So it gets to this question, what can you actually do to weaken the dollar?
Pretty much everyone who's come on this program and talked about this has said the same thing. Those tariffs, to Danny's point, will lead to a stronger dollar. So what tools do you have to counter it? Coming up this hour to discuss some of these themes, we'll catch up with Phil Camporeale of JPMorgan, looking for the small cap rally to continue. Michael Halen of Bloomberg Intelligence as a weaker consumer begins to weigh on casual dining. And Brian Weinstein of Morgan Stanley on why he sees up to 3 rate cuts this year. We begin with the big issue, the great rotation gaining momentum. The Russell 2000 up close to 12% over the last 5 sessions, a move not seen since the early days of the pandemic. Phil Camporeale of JPMorgan says this: if economic data is falling into better balance, that should also mean market leadership can be more balanced. The momentum in equities can continue. Phil joins us now for more. Phil, good morning to you, sir.
Good morning.
Let's talk about that better balance. That seems to be the theme for you. Why do you think that can continue?
Yeah, so we'll start with the economy. So, we just got the CPI number that I think really puts into focus this rate.
Feels like a lifetime ago.
And John, I've been on this show all year saying the economy doesn't need a rate hike, saying stocks don't need a rate hike to continue to move higher. Here's what's changed, and it's about balance. So the Fed has a dual mandate, as we all know. It's full employment and it's price stability. Okay, so we've now gotten 3 straight CPI numbers that have showed a normalization or at least a cooling of inflation. The difference here, though, is the labor market. So a 4.1% unemployment rate. Remember, last year we hit 3% on CPI. Again in the June reading for CPI. What makes it different, though, was that the unemployment rate back then was 3.5%. And people were like, oh no, tight labor market. Can that lead to more acceleration of inflation? That's what's changed. So if you now say, okay, you have inflation that is cooling, not at 2%, we're not talking about that, but cooling, but you have an unemployment rate that's creeping a little bit higher, then that, I think, is what allows not just the one cut, right, like a calibration cut, but I think it also puts into focus next year, and that's what small caps are really, really queuing on. It's the fact that you can now be in an interest rate cutting cycle where all those companies that couldn't finance themselves, whether it be lower quality, high yield, or small cap, those kind of things kind of look the same, now have a lifeline. And I think that's the new chapter that we're in.
Are rate cuts alone sufficient for that trade to work, or do you need the economy to hold up as well?
Yeah, you need a 2% GDP growth economy. So I don't think you need above trend, because I think you can get, a reacceleration of inflation if we have 4 or 5%. That's another big difference from last year. Remember last year when we had the 3% inflation number, Atlanta Fed GDP was like 5 or 6%. It's not that anymore. So John, all of our view, we're overweight equities by 9% in a 60-40 portfolio. That means we have 69% in equity. That's a pro-risk position. We have 20% of our portfolio in high yield. All of this is predicated on the fact U.S. economy avoids recession. We only have a 15% chance of recession over the next 12 months. That's about as low as it gets. And the second thing that's predicated is that the Fed not only did their last rate hike last July, but that they're going to be moving into a world where they can start moving policy rates lower. And John, I haven't been able to say that with certainty until now on your show.
And that's the thing that I'm really taking away from what you're saying is this idea of certainty. That certainty is there. And you write about this, that so much money has been in cash, waiting for that certainty. Yeah. So how much of the small caps is just, I got to put some money to work, and tech's already overpriced? Yeah,
Danny, you asked the right question, and I'm going to date myself with this reference, but that's $6 trillion in cash, and my client saying I can get 5% risk-free is like nails on a chalkboard. I'm not sure if chalkboards exist anymore, but that hurts my ears when I hear that, because that cash of 5.5%, sure, it's risk-free when you look it up in the textbook, but it comes wrought with opportunity cost. And the opportunity cost that I'm mentioning, okay, if you could be in a diversified portfolio, you've lapped the cash return this year. Last year, you tripled the cash return. So, Danny, I think you're 100% correct. That cash on the sideline that gets put to work, we think can continue in a world where all of these uncertainties of rates, inflation, and recession start to shrink. When you can shrink those probabilities, that brings into focus the base case of diversification. There's no such thing as easy money, but diversification is as close as you can get.
Well, those clients that you're talking about that didn't want to leave cash, are they now more receptive to that message? Are they there yet?
Yeah, I think they are, Danny, because again, it was that unbelievable emotion, especially from last year, when folks were saying that the U.S. economy was going into recession. You move into this year, there was a little bit of FOMO. I think what is the difference now is that you can talk to folks about not just going out of cash into diversification, but the first step is usually fixed income. So I didn't want to alarm people by saying there's reinvestment risk with cash, but now you can start to say that in 6 months from now, Danny, I don't think you're going out on a limb and saying that the risk-free rate is not going to be 5.5. And I haven't really been able to say that until now, and I think that'll get people to start moving.
Does the politics change that?
Where?
In the United States of America. Let's say we get a Republican sweep. Does it change that call? Could you make the argument that maybe interest rates have to go back up?
Yeah, so I think this cycle has said never assign a zero probability to any event, right, John, since March of 2020. Listen, there's a curve steepening story, right, that we're not going to ignore in a world of continued fiscal largesse, right? So I think the first step out of cash could be into the middle of the curve, not quite the long end of the curve, given the fiscal situation that we're in right now, John.
I kind of mentioned this to John before, but just as a thought experiment, if we were to price in Biden as the next president, because we moved towards Trump, how different would things look right now? How different would this market look?
That's a good question. I like to keep the politics out of the fact, Danny, that inflation has gone from 9% 2 years ago to 3% today. And President Biden is still the president, right? So I like to take that out. I'm not sure it would look that different. I think the Fed would still be in play. I think the Fed would still be cutting in September if President Biden was at 60% probability versus President Trump. And I think both candidates like to spend, right? So the fiscal largesse story, I think, is still there. So I like to take the politics out of it. What is the trajectory of growth and inflation with what we know now? And I was saying 6 months ago that we only have a 15% chance probability of recession. What has changed is now the certainty of not just one rate cut, but maybe one this year and 4 next year, and then that is the rotation trade.
You're certainly sounding a lot more confident, Phil. It's good to see you, sir. Thank you. Phil Camporeale there of JPMorgan Asset Management. Equity futures near session lows just off them. We're down about 0.9% on the S&P 500. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers.
Hi, John. U.S. mortgage rates fell last week to their lowest level since early March. The rate on a 30-year fixed mortgage dropped 13 basis points to 6.87%, according to data compiled by the Mortgage Bankers Association. The shift down is a reprieve for potential home buyers and an industry looking for much-needed demand tailwinds. The MBA's adjusted overall index of applications, which includes those for home purchases and refinancing, increased 3.9% last week. Shares of Roche trading higher after the company said its weight loss pill is showing promise. The Swiss pharma company saying a new study showed obesity patients who took its experimental pill lost an average of more than 7% of their starting weight. That compares with just a little over 1% in weight loss of patients who took a placebo. Shares gaining the most in over 4 years as Roche says the drug will move into the next phase of development. And the mayor of Paris has stuck to her word, taking a dip in the Seine River to prove it's safe for swimmers ahead of the Olympics. France earmarked around $1.5 billion to clean up the river amid concerns that overflows from the city's sewage system make the river unswimmable. The Olympic triathlon event's swimming leg will take place in the Seine, as will the marathon swim. French President Emmanuel Macron has also committed to a swim in the river at some point. That's your Bloomberg Brief, John.
Yeah, no. Yahara, thank you. Just no. Would you?
No, I have a friend that did the New York City triathlon, and she looked horrifying coming out of the Hudson. That's kind of what I think about.
No. I think that's my answer to that too. Good for them, though, of course. Up next on the programme, the Morning Calls Plus, Michael Halen of Bloomberg Intelligence as a weakening consumer begins to weigh on casual dining. That conversation just around the corner as we count you down to the opening bell. About 1 hour and 17 minutes away. Futures lower. We're negative 0.9 on the S&P. This is Bloomberg. Counting it down to that opening bell, 1 hour and 15 minutes away. We're negative here. We're down by 0.9%. Treasury's a bit softer as well. Yields higher by 2 basis points at 4.18. And this dollar weakness story, we keep going back to it. Euro dollar 109.35. If you check out dollar yen, down to about 156.53. That currency pair's down 1 full percentage point. Just a fantastic sit-down conversation with the former president, Donald Trump, the man to watch at the moment, sitting down with Bloomberg Business Week. And his quote, reverberating through foreign exchange worldwide, "We've got a currency problem." We'll be talking about that currency problem, no doubt, for the rest of this week. It's time now for the morning calls. First up, Baird downgrading shares of Truist Financial to neutral from outperform. The analyst saying after the recent rally in regional banks, he sees limited upside. The stock is down 1.5%. Next up, TD Cowen raising its price target on United Airlines to 80 from 65 and keeping a buy rating on the shares. The firm saying they expect strong results when the company reports earnings after the closing bell this afternoon. We're down by 1.1% in early trading. And your third and final call is from Morgan Stanley, maintaining Carver at overweight with a price target of 90. The analyst saying fast casual restaurants are not isolated from broader pressures, but Carver can continue to post strong numbers and new unit openings. We're down about 0.8% there. Michael Halen joins us now of Bloomberg Intelligence on the state of the US consumer. Michael, let's get into that. State of the US consumer, retail sales look really punchy. When you break it down, though, where are you starting to see a little bit of weakness?
Yeah, we've seen pretty broad weakness this year in restaurants. What we're seeing now is a lot of earnings revisions. You know, we had kind of expected that coming into this year. We thought estimates were kind of too high based on the fact that we were lapping really hard comparisons year over year in January and February. I think most of the street, most of the companies we cover as well, thought that, sales would get better in the second half, but we really haven't seen it. Casual dining chain sales were negative in the second quarter, according to Black Box Intelligence. Quick service saw a modest, 1% gain in the quarter. It was hurt a little bit by weakness in California. We haven't really seen this bounce back in the second quarter that I think most had expected.
And Michael, what do you think is behind it ultimately? Do you think we've reached the limit with the consumer? They won't tolerate price increases anymore?
Price increases are part of it, right? It's really a K-shaped recovery, and so we're seeing most of the weakness from customers making $75,000 and less, and particularly with customers earning $50,000 or less. A lot of them are tapped out, and they've been using their credit cards to pay these higher prices. Inflation is cumulative, right? And we've had almost 4 years now of pretty steep inflation at restaurants and everywhere else, right? And so low-income consumers continue to struggle. On the higher end, it's a little different. I think fine dining may have a little bit of a tailwind here. They're lapping really easy comparisons from last year. Stock markets are at all-time highs. Bitcoin's near an all-time high. Home prices have held in despite higher interest rates. So, what we're seeing is just a bigger divergence in restaurant winners and losers due to this K-shaped recovery that we're seeing.
I mean, you can see that if you just go out on a weekend in New York City, Michael, and you see people lining up out the door for restaurants. There'd been this argument that there was this PTSD after COVID, that people want to get out and their behavior has changed, hence everybody lining up for restaurants. Does any of that still exist, or is the price sensitivity enough that we're just back at normal now?
Well, I don't think the issue is the weekends, right? I think the issue is more so during the week. Right, lunch business isn't as strong as it once was because of work from home, right? And so I don't think people are really cutting back as much on the weekends. I think what we're seeing is, though on a Tuesday night or a Wednesday night, things much quieter than it would be. Also, you also have to remember that New York is different than other places. In the country, people here tend to do pretty well in Manhattan, and so they have the money to eat out, and they're not quite as pinched as those low-income consumers, I had spoken about. But, I think things are getting to a more normalized state for the restaurant industry, right? There's been a lot of puts and takes with work from home and, COVID, obviously, and all the different headwinds they've had over the last few years. But inflation is definitely causing more pause with low-income consumers. And then some of the survey data we've seen recently also states that low-income consumers seem to be a little bit more concerned about their jobs. And so that could be causing some of their apprehension about spending at restaurants. And so in Darden's last call, what they had mentioned was low-income consumers seem to be visiting less. On the bright side, they're not cutting back their checks as much as they have in recent quarters.
Well, this is part of the concern, and it relates to jobs. You can have people kind of pulling back, and sure, it hurts restaurants' margins, so maybe they don't have people work as many hours. But Michael, at what point does it turn that it's not you just have people pull back on the hours they work, but restaurants and food-related businesses need to start letting people go and cutting back on their workforce?
Yeah, that's not something we're necessarily seeing yet. You know, a lot of the casual dining companies we cover are perpetually understaffed. You know, right now they're pretty much at pre-COVID levels. You know, which is understaffed, or probably 95%-ish staffed at this point. So no, we haven't seen any of the companies that we cover. We haven't seen too many instances of companies really cutting back on workforce just yet. You know, that would be obviously a much bigger concern about traffic moving forward.
Michael Halen. Michael, thank you, sir, for the latest. Michael Halen there of Bloomberg Intelligence. What's happening with the restaurant business across this country right now? That final line there on the labour market, a really important conversation we've been having with economists across Wall Street for the last couple of years. If we have an economic downturn, what would it mean for unemployment? Would we start to see loads of layoffs? And given the difficulty we had coming out of the pandemic to hire people, what you just heard there from Michael, there's many companies out there that weren't able to hire enough people, still weren't able to get fully staffed. So what kind of layoffs are we going to expect if we do get that downturn?
It does feel like some of the conversation is turning. The Restaurants of America, the lobby group for them, they were basically surveyed, all the restaurants there constantly. And for a long time post-COVID, it had been our number one concern is staff. Hence you get this labor hoarding sort of environment. That has just recently turned. Only in the past few months, they say that their biggest concern is sales. So at some point, if sales do weaken enough, in order to save your margins, you have to let people go. As we were just hearing there, we're not there yet. But again, that's the concern you get. And when people do start getting let go, is it a nonlinear move?
There is this massive confidence that we'll get this soft landing still. Hasn't gone away. That we'll get this soft landing. And even with this shift higher in unemployment, 3-4%, there may be a stabiliser around these levels. We heard it from Phil Camporeale of JPMorgan just 10 minutes ago. I mentioned the fund manager survey at Bank of America out yesterday. Let's go through some of that again. Investors are very optimistic on the soft landing. 68% of those surveyed versus no landing at 18%, hard landing at 11%. 67% expect no recession in the next 12 months. That's how confident a lot of people are.
And you see it through this market. It's such a fascinating thing when you say, okay, it's going to be so perfect that not only are we going to get a lot of rate cuts, enough to sustain small caps, but the economy is going to be fine too. Usually you'd think if we're in a cycle where we're getting a decent amount of rate cuts, it's because there's something that looks like a recession. That's not what we're pricing it in. We're pricing in, again, something so perfect where you have enough cuts to support small caps, but an economy that's still strong enough to support them too.
Do you want the latest from JPMorgan? So Marko Kolanovic obviously headed to the exit at JPMorgan. We wish him well. He was quite bearish on the equity market for quite a while. There were questions about whether maybe some of this research would shift, it would change. This was from Mislav Matejka, fantastic research strategist over in London, out of JPMorgan, saying this: the slowing growth is likely to impact earnings delivery in the second half. Expectations are rather punchy at 13 to 15% year-over-year EPS growth rate in Q3 and 4. This could be challenged by softer corporate pricing and slowing top line on top of weakening activity, in particular from the consumer. That's the view from Europe in the last couple of days.
The only thing I would say, because I've heard this argument a lot, right? This idea that expectations for earnings are too high and that people haven't been cutting them enough. Usually the reason that they cut earnings expectations is because companies guide them down. They talk to the analysts, they kind of say, hey, here's where we think you should be, because they don't want to have this thing where the earnings don't come in strong enough because expectations were so high. So if companies aren't guiding down, it probably means they're pretty confident that they can beat the targets that are set. So sometimes I kind of take issue with that argument that we're just sort of over-egging where earnings should be.
If you take the banks out of it, though, it hasn't been a great start to earnings season. Day one, it was Delta, disappointing. They got punished. It was PepsiCo as well. And both those companies were basically telling us that maybe the consumer's getting close to being tapped out here. We need to cut prices. We can't raise them anymore.
Yeah, it is the consumer stocks that I think are worrying. And this gets back to the conversation that we had with Dan Greenhouse. Do you know what's in the Russell 2000. There are a lot of consumer names there. There are a lot of banks in there too. Do you know what you're buying? But this is an unrelenting rally. I mean, except for today, it is overperforming. But do you know what you have in there?
Banks and Abercrombie. That's kind of it.
The classic
Decent
small
test.
cap basket.
The next time you sit down with the strategist who tells you they're long the small caps and you should be too, just ask them what's in the Russell 2000 and see how many companies they can name. Decent test for you. Coming up next, Tony Rodriguez of Nuveen alongside Brian Weinstein of Morgan Stanley. We'll have the conversation on the bond market in just a moment with treasuries all over the place. They'll talk to you about the shape of the curve. They'll talk about the steepness of it. Danny, I'm interested in the detail. What's behind that steepener? Is it led by the front end or the long end? The front end rallying or the long end selling off? Is it the politics or the economics that we need to put more weight on?
How much of this is using the politics as an excuse for a trade that you've been calling for the entirety of the year? Because there's so many people who have called for curve steepeners. The front end makes sense. It's Powell, sure. But again, the politics gets a little bit tricky.
The whole curve shifting a little bit higher this morning. 2's up by 5, a 10-year up by 2. 417.50 is your yield on a US 10-year. From New York, this is Bloomberg. Lots to work through this morning. 60 minutes away from the opening bell, with equity futures shaping up as follows on the S&P 500. Pulling back by 0.9%, underperformance once again. The Nasdaq 100 down by 1.4%. Relative outperformance on the Russell 2000. Still negative though. It's down about 0.6%. We'll come back to that story a little bit later once again. Let's get into the bond market. 2-year, 10-year, 30-year. The tug of war we've described on this program repeatedly over the last week. A tug of war between the fundamentals, the economics, and the policy from the Federal Reserve, and then the political considerations, the policy initiatives that might ultimately lead to different fundamentals. Yields up at the long end, the 10-year up by 2 basis points to 417.50. On the front end as well, by 4 or 5 basis points at about 446.32. We talked about foreign exchange repeatedly this morning, haven't we? Weaker US dollar against everything in G10, including the Japanese yen. Dollar yen 156.64. It's a move of more than 1 full percentage point, and it follows some comments from Donald Trump in a wide-ranging Bloomberg Business Week interview. Under surveillance this morning, let's start there. Donald Trump sitting down with Business Week and saying he will let Fed Chair Jay Powell serve out his full term, and that he's now considering JPMorgan Chase CEO Jamie Dimon as Treasury Secretary. Trump is also telling Business Week, we have a big currency problem. Danny, where do you want to start with all of that?
I think we need to start on the dollar because it's moving the markets. But I mean, there's so many things to hear. One thing that he basically talked about it over and over. He sees the deficit, the current accounts deficit, that basically is the big problem. He sees that as this unfair thing in the world that basically the U.S. is importing so much and not exporting so much. It's so much more than the dollar standing in the way. We don't have the kind of supply chains that allow for cheap goods to be made here. And even if we did, does Europe want our giant trucks on their roads? So, I mean, again, that's one element of it. The other thing is, how does it even make the dollar cheaper?
You've lived in London with those fuel prices. I think the answer to that for a lot of people is no, unless they try and sort that out sometime soon. Do you want to talk about Jamie Dimon? I know that Jamie Dimon's got this statesman-like figure over at JPMorgan, and that's the reason why a lot of people always link him with government. OK, if it's not 5 years anymore, what comes afterwards? Surely a man like yourself with all that talent is going to go down to Washington, D.C. Why not become the president, maybe even the Treasury Secretary? We hear this on repeat again and again and again, encouraged by the words of Donald Trump. If we can park the name, let's talk about the caliber. I'm far more interested in that. I want to understand if Trump, with a second term, can attract the same kind of talent that he managed to attract at the beginning of his first term. Rex Tillerson was an inspired hire. We know they fell out, and ultimately I don't think they talk anymore. But there were others too. There was the likes of Gary Cohn, most people who understand trade, Lighthizer, that's a big deal, O'Brien, national security, that's a big deal as well. Can we attract those same names if he gets back into power?
Gary Cohn is one that I was thinking of when you were saying that, because he comes in and they ultimately butt heads over tariffs. That's ultimately the thing that fractures their relationship. So he can attract these high caliber people, or at least he could. But what happens when he talks to them about these kind of policies he wants to put in place? Someone like a Lighthizer agrees with him and could do that. But I wonder about other talent, someone like a Jamie Dimon, who might come into the administration and say, this doesn't make sense.
Glenn Youngkin was quite supportive of some of those initiatives, sitting down with Anne-Marie a little bit earlier this morning. If you missed that, check it out on Bloomberg.com and on the Bloomberg terminal. If you're wondering why chip stocks are getting absolutely hammered this morning, there's a number of reasons, including this one. The Biden administration is considering using extreme trade restrictions on China. Officials are looking at using the so-called FDPR, or Foreign Direct Product Rule, which lets the US impose controls on foreign products that use even the smallest amounts of American technology. This off the back of our reporting, Danny, in the last 24 hours. We've got the likes of Nvidia down by something like 4% as of earlier this morning.
This makes me think that the market was looking for a reason to sell some of these names that they'd been holding up in the rotation. And finally, they don't, because when you look at the story, there's this underlying element of, are the allies actually of the U.S., is the Netherlands, is Tokyo, are they really going to go along with this? When they look at the current state of U.S. politics and they say, you might not be the guy elected in 4 months. Why would we put all these changes in place, which, by the way, will hurt our chip industry that's already been curbed by U.S. curbs, when we don't even know if you're going to be the guy running the thing?
Let's wait a few months and find out if things change. I think we're all asking the same question. How much will things change on the trade front? A lot of people think maybe not much, right? How much daylight is there between the Biden administration and Trump on some of these issues?
I will say one of the interesting things to come that Business Week argument is that he doesn't want to ban TikTok. Of course, it's already law now, so he'll have to go to Congress and get them to undo it. But the reason he doesn't want them to ban TikTok is because of his dislike for Facebook. We know he doesn't like Mark Zuckerberg. That's kind of been a running thing. But again, it's this big tech thing that he doesn't like big tech. It's often for different reasons. Maybe he thinks they don't allow conservative voices enough. They kicked him off the platform once upon a time. But J.D. Vance also doesn't like big tech, too. So that could be a change.
Senator J.D. Vance of Ohio making his address to the RNC a little bit later on this afternoon. Look out for that. Want to get to the Fed speak. New York Fed President John Williams telling the Wall Street Journal the central bank is getting closer to a rate cut, but won't be ready to do so at its next meeting in about 2 weeks' time. This after Governor Adriana Kugler says it would be appropriate to cut later this year if the data continues to cooperate. Joining us now is Tony Rodriguez of Nuveen alongside Brian Weinstein of Morgan Stanley. Gentlemen, great to have you with us around the table this morning. Tony, I want to start with you. Is the data cooperating? Are they ready to go?
The data is certainly moving in the right direction and cooperating. I think it's not there yet for a July cut, but I do think that for September it's setting up pretty well. When you think about July, you still have unemployment that's at a level that's very comfortable for the Fed, arguably still at full employment. While it's risen, it came off a very low level. And the inflation data is still above their target, moving in the right direction. But again, a little bit too early to say, hey, July we need to move, but it's all setting up very nicely so far, assuming we don't get a brand new set of data that suddenly surprises the market, which we've seen over the last 6 months. But right now, we think it's setting up for a September cut and then just a very gradual kind of quarterly pace over the course of the next 3 to 4 quarters in our mind.
Think about where we'll be in September. I think we need to spend some time doing that. OK, we sit here now talking about September rate cuts and how the inflation growth mix is a little bit better, that they can reduce interest rates. Brian, by the time we get to September, we'll be talking about the election even more than we're talking about the election right now. We had Mike Schumacher of Wells Fargo on the programme with us a little bit earlier, and Mike was talking about a window here for this trade to work, maybe a month or two. And then all you'll be thinking about is the political considerations of the next administration and the prospect of looser fiscal policy, maybe even an inflationary trade policy and higher interest rates at the long end of the curve. Is that where you're at?
Yeah, I like that. I like that story. I think we're priced for rate cuts, right? We know they're going to happen. It's hard to recommend 2-year notes here. I don't think the Fed's going to ease more than the market prices in. So they won't. Listen, we have a Fed funds rate that was there for a 9% inflation. Now inflation's going below 3%. So we're going to ease. I don't know why they're not doing it now. Different story. So they're going to ease, right? So they're going to ease, and people are going to extend duration, and that trade's not going to work. Right, I think it's already happened. That's why the yield curve was inverted by 120 basis points at the max. We know we don't have the growth in inflation, that we don't need an 8%, 9% 10-year note. That wasn't going to happen. But I don't think we're going to have a 3.5% 10-year note either. So I think you have a window here where the easing trade works. People rush into duration. Maybe we're done with it. But mine never's been 390. If I could be underweight duration at 390 on 10s, I would be very happy. I'm not sure we get there, but it's the wrong price.
Well, also, this push and pull has also been all about steepeners, and that's down to a lot of the politics. And of course, steepeners work until they don't. And people who just entered that trade have gotten smacked across the face in the past couple of the days. Is that really, you want to be gung-ho about it, perhaps? Perhaps it's been your call since the start of the year. As a lot of people it has. Can you really put it on?
The only thing I really like is not owning the long bond, right? To me, 10s bonds at 20 basis points, to run any chart you want historically. You can go back to Bill Clinton when there were no more treasuries, right? Fine, we were inverted. That's not where we are, right? It's the opposite. So to me, that trade's not negative carry. It doesn't hurt. You don't need to extend duration out to the 30-year part of the yield curve. If we're going to have a weaker dollar, if we're going to have higher deficits, to me, it's the long end of the yield curve. The rest of it, again, 2 notes at 450. Why not own cash at 550 and not roll up the curve? So yeah, I think steepeners are going to be problematic until we get some really nasty growth in inflation numbers. That's not where we are. We're just normalizing. So I think steepeners here are going to knock people around. Negative carry, very difficult. You don't want to marry that trade.
And can I bring you in specifically on the long end? Because again, there has been this argument made that it's a Trump trade, that it's the deficit expanding, it's the extension of tax cuts. How much difference does it really make who's in the White House next year?
Yeah, we think that the fiscal situation is going to be very similar no matter who's in the White House. So the larger term premium result of fiscal deficits that look like they're going to be here for a while because we don't think there's any party that's really fiscally responsible anymore. So in that case, I do think that you've seen the majority by far of the move in the long end. We don't think we're going to see a huge backup from here because we do think the economy will slow. We do think inflation will continue to come down. So the curve steepening has largely been priced in for the first move of it. Now you really need to wait for the Fed to actually get into the game, which again, we don't think it'll start till September, and it'll be a slow process. So the long end is going to be, we think, held up here around these levels for quite some time. And one of the big reasons is the fiscal deficits and the fact that no one's going to address it.
So there's a difference in degree at the long end, but ultimately you're not looking for a big rally here at all at the long end. Where I think there might be some difference is the front end. What I just heard from Brian there about the front end of the curve, I hear from a lot of people, we all do, they come on this show, they go on business TV and they say, don't be in the front end, reinvestment risk. Rate cuts are coming, lock in these yields at the longer end of the curve, make it happen, make it work right now. Brian, what are they saying that you're disagreeing with? What do you think they're getting wrong here, ultimately? And why can our audience actually take some comfort by sitting here and saying, you know what, I don't need to give these guys fees to do anything exotic. I can just keep taking 550.
Well, listen, I think eventually there are things you want to own, and high yield's done well, loans have done well, so cash is one instrument. But I think what they're getting wrong is that we're not going back to the old regime of 1% growth and no inflation, not to mention the fiscal situation, right? So there's more going on. So I think if the Fed's calibrating, right, they're going to go from 550 to 475. The next move could be up again, right? It's not a path from 475 down to 2.5, which I think if you look, if the curve is usually 150 basis points from 2s to 10s, if the 2-year note's going to end up close to 4, the 10-year note ends up close to 5.5. So I think that's what they're getting wrong. We're not going back to the old days of 1, 2, 3% 10-year notes.
Well, part of that story, though, about getting out of the front end, getting out of cash, had been that it's going to power a bunch of other things, that it's going to be this huge power that can mean that risk can keep going. Are you saying that that's not the case?
No, listen, the cash on the sideline thing, I think, is always a bit of a myth. People are making active decisions. That's where they have their money. If everyone sells their treasury bills, someone else has to buy them, right? They don't go away. So there's a give and take here. No, listen, I think it powers credit. I think as you leave cash, you're not buying 5-year treasuries. You're buying credit. You're buying high yield. Look at the dispersion in high yield. What are people buying? Safe high yield, right? What are people buying? The 7 equities that have powered us to get here. That might be more of an index problem. So I think that can expand, right? People can go and find other things to buy that have better return, especially after tax, than 5.5% in cash. So yes, people will buy other things and cash should fall. I'm just saying don't blindly move out the yield curve and think that that's where your cash should go.
People have been buying. They've been putting their money into funds, into fixed income funds in a big way. But Tony, the way that they've been doing it is by active funds. By far, that's what's been attracting the money. Should I interpret that and think there's a bit of beta risk if I just buy a credit fund that's tracking an index?
Yeah, we think that when you look at performance of managers from equity market versus fixed income, in fixed income, you clearly see outperformance versus benchmarks by active fixed income management. So we do think you're leaving money on the table if you go into the index weighted, funds that are out there. We think the opportunity, for example, they're very heavily weighted towards the treasury market. We think the treasuries are overvalued relative to non-treasury spread assets out there. So when you talk about the cash story, you can build portfolios that have anywhere from a 2 to 5 year duration that are going to earn 6%. They're going to outperform cash, and they're going to earn that for the next 2, 3, 4 years, whereas cash will earn you above 5% today. But fast forward 6 months, fast forward a year, you're going to have a 4 handle on that, possibly a 3 handle by the time we get to 2026. So I think that's the reason that you should be moving out a bit on the yield curve, but away from the Treasury market to other more attractive assets.
Just quickly on credit. What are you expecting on credit spreads?
Yeah, so we think credit spreads are probably going to widen a bit from here over the next couple of months. You have volatility coming in from the election. You have the economy slowing down. We've been in a golden age of credit in terms of defaults, for example. So credit's weakening, but we don't see a kind of recession-like environment for credit. Defaults, we think, will rise, but stay below long-term averages. So that means you should see some widening in credit spreads because we may be a little bit overpriced here, but not such that they're going to really, destroy a portfolio like you might see in a recessionary environment.
Because I was going to say credit default swaps, I think they're at their narrowest since 2021 at this moment. And there's a lot of people who look at that, Brian, and say, I'm not getting compensated for the risk that should be priced into this.
I'm a little out of consensus here. I think credit story is going to get interesting. I think in the absence of the fiscal story, what's that saying? Well, Treasury market's is not a great quality credit. And so I think what people are going to do is they're going to search for credits they think are as good or better than the U.S. government. I think the short answer is there really aren't any, right? The government prints the currency, and that's really important. But can you make the argument that Apple should trade through the government? People will. And so I think the high-quality credit spreads are going to continue to see new tights unless we have a hard landing, because people are going to look for things that are not treasuries, that are not cash, and there aren't that many of them. And that's why single Bs are trading like they are in high yield, and that's why the credit market is where it is in credit default swaps. And I don't think we've seen the tights yet, despite the fact that we're pretty close to historical levels.
I just want to get into that a little bit more. What is driving that bid into certain corporates, certain credits that can trade through, say, treasuries?
Yeah, listen, again, it's not my personal favorite argument. I do think it's going to happen.
Well, you've put it out there, so I've got to ask.
I think what's driving it is, again, you can make what's going to cause. The U.S. government is not going into default, but we can get downgraded again. We can be worse fiscally, right? And if you look at the credit markets, especially in the higher grade, there aren't that many single A names, right? There really aren't. And so you get into triple B plus names. And a lot of those names have great cash flow, right? They're being fiscally responsible. They're not going to continually increase their deficit. They're not going to have political issues. They're not all the issues that we're about to go through are not going to happen in those names. And so I do think you're going to see some of these high-quality names trade at levels that don't make a lot of sense from am I being compensated for it standpoint, because people don't want to buy U.S. government bonds.
Amazing. Tony, I want to give you a final word on that. What do you think of that?
Well, I think it's kind of like talking about negative rates, right? It can happen. It's pretty unlikely. I don't think we'll be buying too many corporates through treasuries. Ourselves at Nuveen, probably more selling won't be either. But it's certainly theoretically possible, just like negative rates were. But I don't think it's unlikely. I don't think it would last long if it did happen.
I think we need to get you back and have this conversation at some point if it does happen. Tony, it's good to see you. Tony Rodriguez of Nuveen alongside Brian Weinstein and Morgan Stanley. Some fascinating thoughts there on fixed income. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers.
Hi, John. Amazon coming under fire from Senate Democrats as its annual two-day sales event takes place. A new report led by Labor Panel Chair Senator Bernie Sanders says Prime Days lead to a surge in workplace injuries. According to the report, nearly 45 injuries per 100 workers were recorded in Amazon warehouses during Prime Day 2019. Amazon responded, saying the report is wrong in its facts. Elon Musk is moving the headquarters of his X and SpaceX businesses from Texas from California. The outspoken CEO made the announcement on X after expressing frustration over California's new law related to transgender students in public schools. Earlier this week, Musk endorsed Republican presidential candidate Donald Trump and pledged tens of millions of dollars to his campaign every month. And staying on Elon Musk, Cathie Wood is making a bold call on his Tesla. The ARK Invest CEO saying the company's move into the autonomous taxi business will be a catalyst for a roughly tenfold increase in its share price. Wood has been bullish on Tesla for a long time, making it a top holding in her ARK Innovation ETF. Tesla shares are up 3% this year, while Wood's fund has lost nearly 9% this year. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate this morning. Great work as always. Up next on the programme, we'll set you up for the day ahead. We'll go through some of the data points you need to look for, some of the Fed speak and the big one, an address to the RNC from the big VP pick. Senator J.D. Vance. We'll catch up with Anne-Marie on the other side from New York. This is Bloomberg. Had a decent run on the small caps, haven't we? Better than decent, better than good, I get that. On the S&P 500, 3 days of gains coming into Wednesday, pulling back just a little bit, going into the opening bell, about 40 minutes away. We're negative by 1 percentage point. on the S&P. In the bond market, Treasury's selling off as well, just a touch, much more so at the front end. At the longer end of the curve, the 10-year yields higher by 3 basis points, approaching 420 again, 418.66. And the dollar story we've been talking about repeatedly through this morning. Dollar weaker against everything in G10, euro dollar 109.42, firmer there by 0.4%. As we count you down to that opening bell, here's the trading diary and the day ahead. It looks like this. Fed Beige Book coming at 2 p.m. Eastern Time, plus Donald Trump's VP pick, J.D. Vance, taking center stage in Milwaukee at the RNC later this evening. Tomorrow, we'll get another round of jobless claims and Netflix reports after the closing bell. Plus, Donald Trump will formally accept the GOP nomination and deliver his speech, rewritten, he told us, after Saturday's assassination attempt. Joining us from the RNC, I'm pleased to say, Anne-Marie's back with us. AMH, let's get to it. Senator J.D. Vance of Ohio gets the nod. He is the VP pick for Donald Trump. What can we expect a little bit later this afternoon?
Well, he's been making the rounds, Jonathan, at the RNC, showing his face on the floor, sitting next to the former president, listening to others, especially yesterday. But now we're going to hear from him for the first time on stage as Trump's VP pick. He's likely going to lean heavily into his background. He wrote an entire memoir about this, and he's going to talk about growing up in Appalachia, growing up really on the edges of poverty, and why he now sees Donald Trump's policies working for middle America and the middle class and the lower income. There's going to be a tremendous amount of scrutiny on this individual, though, because can you imagine 2016 when Donald Trump first won and took over the White House? J.D. Vance was a political contributor on CNN, and he was bashing him. You can go back and read everything he talked about and said about the former president. 2024, he is his VP pick, and he's going to try to support him in 3 key states, the Rust Belt. This is where Trump thinks potentially a pick like J.D. Vance can help him win. Michigan, Wisconsin, and Pennsylvania.
There's a lot of reasons why he was picked, Anne-Marie, but I think the important one is the story of his that you just described. If you think about the post-pandemic cost of living crisis that's dominated not just this country but others as well, the incumbent in elections across Europe, in the UK, in the United States has been punished both in the polls and at the ballot box for those that have had elections. And I just wonder, Anne-Marie, if that's what this is about. This is an individual that can go to these states and actually communicate with these people, relate to them in ways that politicians who have been in D.C. for decades just can't.
Absolutely. And Donald Trump himself is an incumbent. He's not the sitting one, but he is an incumbent. J.D. Vance has only been a senator for a year. He's relatively new to Washington, D.C. He's certainly not from the establishment. So he has a really fresh vibe in that sense, even though he's definitely from the far right of the party, which solely represents Donald Trump. And this wasn't a pick that maybe potentially could help him expand into the center. So that is going to be on display. Also, the sheer fact, Jonathan, he's 39 years old. He turns 40 next week. When you have an election, when you have someone in his late 70s running and someone in his early 80s running, this is an individual that just screams youth.
Well, you said it there, Anne-Marie. He's not necessarily someone that helps expand into the center. Nikki Haley, though, perhaps is someone who can. And she spoke yesterday. What inroads did she make to try to help widen Trump's base?
I think really what she did is she really closed the fraction we saw between Trump and herself. You know, she potentially wouldn't have been here if there wasn't that attempted assassination attempt on the former president on Saturday. That's when the phone call was made. There was one thing that was interesting, and I'm not a lip reader, so I couldn't tell what Donald Trump was saying to J.D. Vance. But when she said, Donald Trump called me to get me here, to come speak, to talk about unity in our party, he looked over to J.D. Vance and said something to him and kind of laughed. I couldn't quite understand what it was, but clearly there was a phone call that was made. But she made it very clear last night. She doesn't agree with Donald Trump 100% of the time. And she said, if you're going to vote for him, you might not. But she still is urging her supporters to vote for him. And then one of the first things she said when she came out on stage, even though she was also being booed, is she said she wants to make it clear she endorses him 100%. Period. Those were her words.
Anne-Marie, really enjoyed the conversation with Glenn Youngkin, the Virginia governor and former Carlisle guy, a little bit earlier this morning, on whether this party, this administration, will truly be pro-business in the traditional sense. What was your takeaway from that exchange?
My one takeaway from that is yes, because what Governor Youngkin was saying when I was trying to get his what he thought his first impressions of young Senator J.D. Vance and some of the protectionist, populist rhetoric we've heard from him, and the fact that he does unnerve the business community. I've been told that a lot of Wall Street individuals were calling Trump, trying to make last-ditch efforts to pick a Governor Youngkin himself or a type like him in his mold. And he said, let's make one thing clear. This is Donald Trump's policy. And J.D. Vance is basically stepping him to see Trump's policy move forward. So even if there is a little bit of division, where these two align, when it comes to J.D. Vance and Trump, and potentially they're protectionists or populists in different ways, I got the sense from Governor Youngkin that this is Trump's policy, it's his plan, and J.D. Vance is just going to help push him forward.
Interesting. Anne-Marie, thank you. Wonderful work. Looking forward to seeing you back in the studio here in New York next week. AMH is going to be at the RNC through the next 24 hours, 48 hours, and break down the speech from J.D. Vance later on this afternoon, and then tomorrow from Donald Trump himself. Coming up tomorrow, here's the lineup for you. Jay Pawlowski of TPW, Thomas Kennedy of JPMorgan, Subhadra Rajappa of SocGen, and Jeff Yu of BNY Mellon. I wonder if we wake up this morning, Danny, still talking about the FX market beyond this morning, going into tomorrow.
I think why it's so hard to have conviction in this market, because you can get slapped by the politics or by the economics. It's a lot of back and forth, and for now, it's just the only thing that is for certain is some form of a rotation is happening.
Big rotation in the last week. We pulled back across the board this morning. We're down 1% on the S&P 500. From New York City this morning, good morning to you all. Thank you for tuning in. This was Bloomberg Surveillance.